Yo, what is up, everyone? Welcome to another stream. Welcome to another show. I hope you're doing well. Today is Tuesday, September 1st. So we are officially in the next month. And things are flying by on my end. Time is moving really fast. So one thing that I saw on Twitter today is from a guy that's supposed to be like a neurosurgeon. Now, everyone on Twitter is like a doctor or an expert at a topic, but this guy is supposed to be the real thing. And he mentioned, so if your days seem to be the same, and if time seems to be going really fast, it's usually because you're stuck in some sort of a routine, because your brain remembers new memories pretty well. While if you're in a routine, everything is the same, so you don't create as many memories. The way to get out of it is to do something new. So join a new course, switch your gyms, do a different schedule, go to lunch at a different place, take your girlfriend on a date on a random Tuesday or Wednesday. So that should help with breaking up the routine. So that's something that I learned today. It seems very interesting. I'll give it a try because I'm going to tell you this summer has been pretty, I wouldn't say boring, but I've been grinding. I've been grinding it in the trenches of trading. Performance is pretty good, so that's going well. I can show you my Darwin-X. I got some new allocations there. Darwin-X 0, my dashboard. I'm not sure why it's not updating now, but it should be above 300K. I'm not exactly sure. There's still some things going on in the background. So if we go to see details, allocation, yeah, okay. So it did say above a 300K. Now it's 231, which is still pretty good. So I guess some sort of a rebalancing is needed here. Anyway, I finished August plus 2.73%. I'm supposed to get a payout tomorrow, I believe, which is gonna be, let's see, in the performance fees. It's stuck in loading right now. Looks like there's a bit of a bug on the site. Yeah, around 2,400 euros. Can you hear me well? I think you should be able to hear me well. Anyway, so 2,400 euros. In fees should come tomorrow, estimated payout 2nd of September. So we'll see if that is going to happen. The trades that I have running at the moment are here. So I have the Aussie dollar long, where I took half off and let the rest run with a trailing stop loss. I have Aussie NZD, which is retracing today. I have a buy on gold, and I'm potentially looking to sell USD CAD. So if we go to the currency strength chart for today, let's take a look. Currency strength. What's going on today? The dollar is actually going up. The Aussie is crumbling for some reason. I don't know why. I don't think we have much on the calendar for today. Yeah, today is a pretty non-event or not non-eventful. Tomorrow we do have the Aussie GDP. We also have the RBNZ cash rate, the meeting, and the press conference. So that'll be pretty important for my Aussie NZD position. Now, personally, I'm betting for the New Zealand dollar to lose some value because the economy in New Zealand is not doing that well, especially if you look at the unemployment and if you look at the amount of rate hikes that are priced in for the RBNZ. Economic data, labor, unemployment. Let's see, NZD. Okay, there's some sort of an error here, but the employment in New Zealand is definitely elevated, plus it's overall going to the upside. If we take a look, so it was 3.4%, now it's running at 5.3%. Definite rise. We're approaching the 6% mark. which is problematic. So that's not such great news for the New Zealand. And then if we go to the rate probability, unfortunately we can't do the RBNZ because it's locked. Okay, they're running ads. Yeah, RBNZ is closed or locked because I need to pay for the subscription. So unfortunately, I can't show you how many rate hikes are priced in, but a lot. You can also go to the Edge Finder, by the way. Go to interest rates, projections. If you look at let's compare the Aussie to the NZD. So you can see the Aussie is probably going to stay flat, while the NZD, the red bar, is climbing up a lot. So there's a bunch of hikes. There's a bunch of hikes priced in for the RBNZ. Yeah. So from the current rate, which is 2.5 to 3.8%, that's very hawkish. And that is something that personally I don't think can happen with the current unemployment rate in New Zealand. So that's the game plan with this position. Plus, you also have the New Zealand elections coming up in November. So if we go to Polymarket and we go to New Zealand legislative election winner, Labour Party is at 56%. Also, let me just send the link to James so that he can join after me. Let's go to live stream chat. Okay, I've posted the link to our Discord in the live stream chat so that all of the guests can join. Yeah, look at this. So the Labour Party is winning at 56%. Now the volume is okay, 58,000 here. It expires November 6th. So the volume is okay. It would be better if it would be above 100K. That gives you a more clear signal. But this is telling you the Labour Party is winning. And the Labour Party, if you do your research, the Labour Party is for lowering the unemployment rate. So one thing they are saying, they will lower the unemployment. And the way to lower the unemployment is to cut interest rates or be dovish in generals. And being dovish is bad or bearish for the currency. Gold is down on the day. I don't know why. I don't know what is happening to gold. It's my trade is in a bit of a drawdown now. So it's not looking so healthy. I'm going to stick to it. I'm going to keep on holding it. That's why the stop loss is in place. If the stop loss gets activated, I was clearly wrong. I also need to mention my win rate is only around 50%. So half of the trades that I take will end up as losses. Okay. So yeah, I don't know why it's pulling back. I don't know why AU is pulling back. I can see the DXY is up. I can see the yields are definitely up on the day. So the long end and the short end and the long end are both going to the upside, which could bid the dollar a bit. Yeah, it definitely could place a bit of a bid on the US dollar. Let's see, oil is going up as well. So we're getting some risk off. We're getting some possible escalation in the Middle East. The strait is still closed. So if we run through the Hormuz traffic, let's take a look. Last update, August 23rd. Okay, so the last update was a while ago, like a week ago. It's zero. The transit trade volume is zero as well. And you have the update notice due to technical difficulties. This week's data release has been delayed. Okay, unfortunately, it has been delayed, but okay. What else can we take a look at? Crypto. Crypto not doing much, just consolidating here. Bitcoin not doing much. So I need to see something, either a break to the upside or a breakdown lower. we can run through the breaking news. So one thing that I do every morning to prepare for the trading session is I run through financial news through the breaking news. So first, market moving. Last one was from Trump. The US will respond to Iran's attack on US forces. Kind of a heat up in the Middle East. Does it matter much? Personally, I would say no. Personally, I would say it's just noise and to ignore it. Then I go to Forex. And let's take a look at here if we have something. So let's go lower. You have some Eurozone stuff. I focus on the stuff that is highlighted in red. Let's see. This is the currency strength chart that we looked at. You have some Iran stuff. Chinese stuff, Australian. Nothing much. Nothing much, really. US Treasury Besant, my belief is that the Japanese government and the BOJ will do things that will lead to a stronger yen. I think the exact opposite thing is happening. Let's go to USD JPY. Yeah, we're back at 160. It's not looking great. It's not looking good. Let's see USD Swiss. A complete retrace of the move that we had from Besant. Euro Swiss, same thing, complete retrace of the move. Euro Yen is probably staying a bit flat. Yes, not doing much. The credibility with Scott Besant is very, very low. So he's been saying a lot of things. He's been saying lower inflation. He's been saying lower oil prices. He's been saying yen goes up. Nothing has happened so far. Yeah, the credibility is not good. You also have like kind of an open season on Besant, where on social media everyone is kind of dunking on him. You also have his previous mentor, as the chat calls him, Drunk Miller, but I think it's Drunken Miller. It's not Drunk Miller, but let's call him Drunk Miller. So he was mentor of Besant, and he said that Besant is doing the wrong thing by trying to intervene in the bond market. So the market is not listening to what Besant wants to happen, which is pretty funny, I would say. I always love to see politicians having to basically walk back on their word and eat some crap online. It's always pretty funny. I'm just going to scroll through until the morning of yesterday. CENTCOM, no ships have hit mines. Then you have this big kind of market moving news, which is not really big news, I would say. So now it's 2 p.m., now it's noon. Not much. And this is, I think, where we left off from yesterday. So that's about it for the breaking news. Comments. Let's see the comments. First, I want to welcome everyone. I want to say good morning, or good evening, or good afternoon, depending on which session you're trading. Let me know which session you're in. Are you in the London session, Asia session, New York session? So let me know in the comments. I am in the London session. I am London +1. So I'm in Croatia, by the way, which is 1 hour difference from London. Hello, you sleep here. Hey, what's good, chat? Good morning. Hello, Amarifin. Hello. 4.225 possible. Please explain. Are you talking about gold? Hello, everyone. What's your insight on PMIs? PMIs, are they even highlighted in the red? Okay, yeah, US manufacturing PMIs, non-event. I would say non-event. I'm not following it personally. Like in the past few months to years, this hasn't been a market moving event unless you get a complete miss. So unless you get a super crazy miss of the forecast or a crazy difference between the actual number and the previous number, it's not going to move the markets. That's just how it works. New York, what about your gold trade? I like, Sluggy says, I like metal longs with BTC short covers. London and New York, Ireland, Asia. Hello, good afternoon. Gold trade. Imagine seeing your mentor dunk on you. Yeah, not a good experience. Drunk Miller basically kind of roasted Besant, and Drunk Miller is supposed to be the mentor of Besant. But you know what? At the end of the day, all of those guys are millionaires, maybe even billionaires. Like, do they care? They have millions in the bank, and once you get to that level, you probably just don't care what other people say. You're just pretty well off. So whatever happens to the markets, you just don't give a crap. So I think those guys are actually laughing at us and not the other way. What I want to do, gold trade. Yeah, not doing good at the moment. Pretty bad actually. Kind of at the half point of the drawdown. My stop loss is at 4288. I think I got a question, why do you run such a big stop loss? My answer is, if you run a big stop loss, you can never take a loss. So your win rate is 100%. Now, that's a joke. The reason I run a big stop loss is because it fits my plan. And it's just the way that I like to structure positions. I like to give trades breathing room, plus it increases the win rate. So I've been trading since 2021. I've started with a very low win rate, high reward to risk strategy, which means I took 8 losses and 2 winners. So the win rate was 20%, but the reward to risk was massive. So it was a profitable strategy, but with a very, very low win rate. Now that was tough to go through. Psychologically, it was very, very tough to take all of those losses and to try and find those winners. So I said, I want to switch it up. I want to do something different. I want to structure my trades with a bit of a bigger stop loss and a smaller take profit or a lower take profit to improve the win rate. And so far, it's been working well. My win rate climbed up to around 45 to 50%, I would say, which is much easier to deal with. You know, with the previous strategy, most of the days I woke up to a loss. Now, most of the days or half of the days I wake up to a winner. So half of my days are good feeling and half of them are bad feeling. And trust me, the emotions you feel in trading, they translate into your whole day. So I know when I take a loss, I'm in a bad mood. I don't do my chores. I don't go through my to-do list, or I kind of slack off. I eat out, so I eat shit like McDonald's. It impacts your life a lot. So the win rate you have has a direct impact on your real life. I know with enough experience you can control it, but it just makes it a bit easier if you can improve the win rate. One way to do it is, if you do have an edge, you can increase the size of the stop loss and grab a lower reward to risk, but catch more winners. So you can do like 45% win rate, and your average reward to risk can be 1.8 to 1, which is really good in my opinion, which is pretty good. So for the gold trade, I'm holding it. I don't know the reason why we are selling off today. Personally, my forecast was for this move to get completely retraced, because I thought this was an overreaction from the market, from the hawkish Kevin Moore speech on Friday. I thought this was going to get faded. It's not the case. The market seems to be following through, and the dollar seems to be gaining some value. That's how it is at the moment. Plus, you have the long end of the bond market going up, which makes bonds more attractive, potentially, which removes some capital out of gold and maybe puts it into bonds. That's usually how it goes. Bond yields and gold have an inverse correlation, right? Because if bonds can give you 6-7% per year, why would you want to buy gold? That's what some people are thinking when bonds are supposed to be much, much safer. At least I actually think gold is much safer as an investment, because the US can always something can happen to the bonds, right? You can have some sort of a crisis, but gold is always going to be gold, physical. If you can keep physical gold, that's the best one. In the last thousands of years, if you held gold, you did pretty well, no matter what happened in the world. Gold is the savior, right? The internet can stop existing. You can have a glitch with Bitcoin. Bitcoin can get hacked by quantum computers. You can't hack physical gold. Only thing that could happen is what they did to diamonds. So essentially, diamonds, you used to need to dig them up. Now you can make them in a lab, and they're even better than the ones that you dig up. Like the chemical build is the same. So it's a real diamond, but it's made in a lab. If they can do the same thing to gold, make gold out of some shitty materials, which they probably can't, well, then the value of gold goes down. Or if they discover gold reserves on Mars, if SpaceX discovers massive gold reserves on Mars and manages to bring them back, then your gold devalues. But I think that's the least possible scenario when you look at things like a potential crisis in the US, potential debt spilling over, potential quantum computing hacking Bitcoin. That's why I think gold is the best. Or it has the least amount of risk. I do want to mention, if you want to join the A1 Trading Discord, you can join for free. You don't need to pay anything. You can test it out. You can join for free. The link is on your screen with the QR code. Also, it is in the description of the stream. And finally, I will post the link in the chat. So I will post the link in the chat so you can take a look. Okay, it's a free Discord, and I think I would say it's the best Discord in the space. I've been through many of them. I've been trading since 21 as a serious trader, and before that, I've been dabbling into crypto and in trading for 2 or 3 years. I lost some money with Bitcoin buying the top in 2018, but I've been in a lot of Discords, so I have the Discord experience. This one is, I would say, the best. Like the people you have in there, the traders, not just the mentors. I would say, so the members like Max, like Sluggy, and I'm sorry, like I think it's Robohola. All of the nicknames, basically. If I forgot someone, I'm sorry. I'm pretty bad with names. But you have a bunch of profitable traders getting steady payouts from prop firms and building their personal accounts that can help you. So if you're an X, I cannot post the link because I don't have access to X. But what you need to do is just go to the A1 Trading website, okay? Just go to the A1 Trading website, or what we can do is I can open it up here to show you. So let's try and copy the link. Copy link. Will that work? Hopefully it does. Yes. Okay, if you can see this on the screen, essentially it's a JotForm link, and then there are some numbers. So it would be best if you can go from X to YouTube. Just switch to YouTube, and in the YouTube description of this live stream, you'll find the link to join the free Discord. I'm sorry it's that way. It makes things more complicated, I know, but that's just the way that we are going to have to do it. Can you analyze the SPX? Yes, I can, absolutely. Any setup for gold trades today? No. Euro CPI goes up. What do you think? A hike rate or a hawkish stance? Yeah, hawkish stance, yes. But one thing that I'm looking for the euro, look, winter is coming. Winter is coming. You have energy that is elevated. Europe is a big importer of energy, and they use the energy for heating. So essentially what is going to happen, it is going to take more euros to buy dollars to buy energy. So you're going to have to sell your euros. You're going to have to sell more euros. And if you sell euros, guess what happens to the euro as a currency? It devalues. The value goes down. So I would say a potential setup is to sell the euro going into the winter. I wouldn't do euro dollar because I'm already betting on a weak dollar. I would consider euro Aussie because in my opinion, the Aussie is a strong currency at the moment. And that would be if we break this support level. So if we can break this level, then I think euro Aussie could be a good candidate. If we don't break the level, I wouldn't sell because selling at support is not considered good trading. Are we waiting for news before we enter any trade on gold? I'm already in a position, not looking to enter a new one. When you started trading, were you focused on swing trading? Yes, fortunately, from the start, I was. I've tried different things. I would say swing trading is the best. Okay, swing trading is absolutely the best and the easiest way to get into the niche, right? Or the niche into the industry. Scalping, the edge with scalping is extremely low, probably even non-existent for most traders. Then investing is too long. You're gonna be active very little. You're not gonna learn much. Swing trading gives you that happy medium where you learn a lot, you take a lot of positions, but not too much, and you can actually build an edge because you're not trading on the 1 minute or the 5 minute. So the sweeps, the swaps and the commission and the fees doesn't eat into your edge too much. I'm short on GJ. As far as the yen goes, yes, I would say the yen. I'm betting on a stronger yen, but I'm just not seeing it happen. Like the yen is just losing value. The only thing that seems to be moving the yen is the intervention. This. Other than that, the yen is like a bad currency at the moment. It's just losing a bunch of value. See? Now, if we do get a rate hike cycle from the Bank of Japan, and we do have a Bank of Japan meeting in September, I think late September. So if they do start a hiking cycle, I mean a real one with back-to-back rate hikes, that will help the yen. But so far, it doesn't look good. The only thing they can do at the moment is they can intervene. And they don't have unlimited capital, so they're not going to waste a bunch of capital to try and intervene. So it's not looking good. It's not my favorite position at the moment. I would leave yen on the side, unless you're going to bet on an intervention. Then maybe if the Bank of Japan starts a hiking cycle, then yes, sure, we can get in on a nice uptrend on the yen. But that is still in the air. What will be the impact on market of all the yields rising? Is it still to support the XY? What about impact on indices? Well, if there's going to be a slow grind to the upside on the long end and not like a big shock, then I think that's actually a bit bullish for the US dollar. If there's a slow grind, because it's hawkish, it makes the dollar more attractive. It makes the bond market more attractive. Things like gold do go down. So gold does tend to go down when you get the long end to go up. Do you think gold will reverse? 10 bonds nearing 4.8. Let's see. My key levels are, okay, we're starting to break out on the 10-year. I guess that is why gold is going down and the dollar is going up. So we're starting to break some key levels on the 10-year. I would say 4.85 is the upper range that I'm looking to see get broken. It's kind of this high right here. And it's a nice round number like 4.8. This is interesting. We're getting definite movement in the 10-year. Although if you zoom out, ever since 23, we are overall in a range like this. So we need to mention that. I have 1 more minute, so let me do the SPY. The SPY is down. I'm not looking for stock breakouts because we are below the EMAs. The first rule that I'm looking for to buy breakouts on individual stocks, the SPY needs to be above the 50, the 20, and the 10 EMA. It needs to be in a clear uptrend, needs to be near all-time highs, and needs to be looking healthy. This is not it. We're starting to pull back. We're starting to correct. So personally, I'm laying off buying stock breakouts. Bashi, hello, welcome. That's it for my segment. You have James coming on in 30 seconds. I will play a quick transition, and you can catch me again in 2 hours. So thank you, and see you in the second segment.
If you're looking to get funded and want to save big on prop firms, check out our website, A1Trading.com. On our website, we have a massive catalog of different sponsors and prop firms that are offering really competitive prices to our live stream viewers. On the screen right now, you see a QR code. If you scan that, it'll take you to this page that I'm looking at to scan all the different offers. You can also filter by 1-step and 2-step accounts. You can also look at futures, Forex and CFD prop firms, and even prop firms offering stocks. You can also select your preferred prop firm challenge size and check out our menu at the top for tons of different prop firm perks and giveaways. For example, every Monday, we do a weekly prop firm giveaway that you can sign up and add your name into the hat for free. Additionally, we have prop firm reviews for notable firms, and we even have a side-by-side comparison tool where you can compare two firms head-to-head. Save big and find the right prop firm for you over on our website, www.a1trading.com. Thanks to our various sponsors who make this show possible. Now back to the content.
Hello. Happy Tuesday, ladies and gentlemen. Hope everyone is well. Hope you're all having a fantastic start to the week. Wow, that's crazy. Did my eyes deceive me? Bashi is here. Not seen you in a while, my friend. Hope you're well. Yeah, long time no see. I'm good. Thank you for asking. Same old. Looking fresh. Thank you, Turkish barbers. Is Nick out? No, Nick will be on pretty soon, I think. So what you can always do, if you are wondering when a certain guest is coming on or when Nick's coming on, you can just go to the A1 Trading website. Somewhere on the site, if you go to a live stream schedule, you'll be able to see who's on and at what times. And this will, I think, switch to your local time zone. So obviously for me, this is UK time. For you, it should change. But yeah, Nick will be on after Alan and Alan is on after me. So there you go. That is today's lineup. And then after Nick, we have Alan and Marco coming back on for a joint segment. Wow, a lot of hellos. Candice, I think. Hello to you. 2288, good to see you. Digital content, KDX, Christoph, good to see everyone. Hope you're all well. Really like you. Really like the new schedule. Good stuff. Yeah, the schedule's cool. They've done a great job with that. NFP week, indeed. Yeah, we'll see how things go. Yeah, we can move on to NFP and some of the data later on, because I would quite like to cover the Fed and the US dollar in a bit more detail. But for now, we'll keep it simple and we'll ease into the stream. So hopefully everyone's doing well. Okay, so I'll be honest, I'm actually looking towards going short on the short on gold and potentially silver as well. So I am still in my long positions on gold that I've been telling you guys about for the past couple of weeks. So I've got a short-term speculative swing position here that is clearly not doing very well. And this one basically was just the low to the high, obviously using the fib. Edge finder's bullish. We came into previous structure here on the left. It's completely failed so far. We are still holding this 200 moving average on the H4, which could be maybe a support if we are fortunate, or if I'm fortunate, but I'll be honest, I'm not overly optimistic on that. However, the other three here, as I've been saying, are very small size. They're like 0.01 lot size, but the idea is to build that position over a longer period of time. Now, I'm looking to maybe go short, and this isn't a definite thing. This is a big sort of question mark. I'm currently considering the idea of actually pivoting my bias a little bit. So the way that would work is, and I'm going to get onto why I'm pivoting my bias in a minute. I'll go through the action plan for now first. So what I could do here, which is what I'm quite tempted to do, if we do see the H4 flip bearish, so the moving averages cross over, the edge finder loses some of its score or some of its bullish score, maybe it drops back down to neutral, whatever it may be, we start clearing out previous lows, we get those typical technical signs that buyers are just not holding up and the trend could change yet again. So once we get those things aligning, I could obviously, well, at that point I will be stopped out of this trade. I could keep these three trades open and offset the risk or the drawdown here by actually just taking short-term swing trades. So, 1 to 2 week sort of horizons, and continue to do that, offsetting drawdown while I'm DCAing, whilst also still building a long-term base for my, multi-year bullish thesis on gold and silver, copper, and other things. So that's one way I'm sort of leaning at the moment, is to actually be long and short at the same time, but both ideas or both directions, different time horizons. Okay, so with the US dollar, or actually, you know what, let me put the yields on as well. So we'll go 2-year, we'll add the 10-year, and we'll also add the 30-year as well. We'll do new price scales here. So we are seeing yields screaming to the upside. I mean, they've been coming to the upside for quite a long time at the moment. Quite a long time, really. But what we are seeing at the moment is a real move higher. And as Marco said, they are starting to break the previous highs as well. So realistically, we've got, I mean, Nick covered this really well. I've got a video coming out pretty soon about it as well. But the simple way to think about this really is, if you can basically lend the government money, the money you're going to get back, the interest on that is heading towards 5%. You know, here on a 10-year yield, we are at 4.7, or round it up to 4.8, close to 5%, we'll say. What is the benefit of holding gold? Well, there really isn't that much. The opportunity cost really actually outweighs buying gold, and actually you should be holding treasuries or bonds. So that's one thing that I'm starting to sort of reconsider actually, is, am I really that bullish on gold? Again, long term, yes. Short term, I'm not that optimistic, to be honest. And what we are seeing is Fed rate hikes getting priced back into the market quite aggressively when this loads, we can see. So we can see a week ago, we had a 39, well, let's say 40% probability of a rate hike in the next meeting. That's now increased to 66.4. So the likelihood is, again, based on just this, the probabilities aspect, we are heading for a rate hike in the next meeting. I don't fully lean into that just yet anyway. But again, that it doesn't matter what I think. The markets do what the markets do, and I've got to listen and pay attention to that and react off the back of it. So that's the current thing I'm paying attention to, really, is more of the Federal Reserve stance, forward guidance, and also what the markets are actually pricing in. And as I said, it just doesn't look like a favorable condition for gold at the moment, in my opinion. And I'm fairly sure oil is moving higher as well, if I'm correct. Yeah, oil is also moving higher as well, which, as we've seen, has been a negative for gold over the past couple of months, basically since the start of the year. So I think there are all these little factors that I think really actually, again, are not conducive for gold's upside, which, you know, is a pivot from what I've been talking about over the, you know, the past 2, maybe 3 weeks. I've been very, very bullish on gold. But after some reassessment over the past sort of 12 hours, I'm kind of now, again, as I said, starting to lean a bit more on the bearish side. But we'll see. We'll see how it goes. Good to see you. Haircut looks dope. Thank you very much. I appreciate that. It's a little bit too short for my liking, but I suppose that just means I don't have to pay for a haircut again for a little while. Okay, so yeah, that's the thing on gold specifically. But then when we look at the US dollar, the reason I said I'm not buying into the rate hike idea on the next meeting is just because of the data that we've got. So obviously we need to understand, and again, I've covered pretty much most of this yesterday, so I will repeat myself a little bit for anyone that missed it. But the Federal Reserve has basically 2 jobs. It's called the dual mandate. It's controlling inflation, essentially, and also ensuring stability within the labor market. Now, what we're seeing is obviously inflation is elevated. We did see a little bit of a cooler print here on PPI, but it's still double, or actually over double, the target, which is 2%. So in that regard, inflation is still elevated quite significantly. But then we look at the labor market, which actually, in my opinion, really isn't looking good at all. Have I highlighted the right thing there? Yeah. So as we can see, wage growth has come down. Unemployment came down, but if we look at a participation chart for the US, that's also come down. So that could mean that it's not as surface level as people getting jobs, unemployment's come down. It could mean, and this is a big could, it's not a definite, could mean that people have actually just more given up rather than actually getting jobs, if that makes sense. There is also the idea that actually we've had a massive spike in retirements in the US. So it's more of job replacement rather than job creation. So I'm not convinced that the labor market is in a good condition in any way at the moment. Jobless claims is down. JOLTS is down. ADP down. NFP is also down. So I just don't see, and growth also is down. So I just don't see the condition at the moment that warrants a Fed hike immediately in the next meeting. But I do still expect a Fed hike at some point, whether it's later in the year or in 2027. But yeah, as I'm saying, as I'm talking about in the next meeting coming, I don't want to say I don't think a rate hike is coming, because that is what the market's expecting. Who am I to argue with that? But again, just from my observation here, it doesn't really warrant a hike at the moment. I think JPY, you think the BOJ is going to hike? Percent said he wants it and likely to also intervene after FOMC. It is possible. So with dollar yen, something I am a little bit cautious of. So I am still long. Actually, I should probably trail some of these stops. I'm actually just going to write that down because I'll forget. Hold on. Trail UJ stops. Okay. Right. So that's in my notebook. So I need to trail the stops on dollar yen. As I said, sorry, I lost my trail of thought a little bit there. The concern I had was, and it's possible to still come into play at the moment, is what happened. Obviously, actually, let me just redraw this. Is 160 was kind of the line in the sand for the MOF or Japan, let's just say. So when dollar yen got to 160, we saw this defended quite heavily. There is only so much money really they can justify with interventions, because again, as we should all know, interventions don't actually do anything fundamentally speaking. There is no rate change, no policy change. It doesn't do anything other than move price in a different direction. Do you know what I mean? Just strengthens the yen temporarily. So the markets clearly see these opportunities as just buying the dips. So they gave up 160 very clearly here. It got to 164, and I think, and again, this is me sort of just making some educated assumptions, I suppose you could say. Dollar yen got to 160, which was a very uncomfortable point for Japan. The higher dollar yen goes, the bigger the problem it is, essentially. So 164, big problem, not good. MOF intervene, Fed intervene as well. Get it below 160, and does this then provide the MOF the 160 level again to defend? Do you see what I'm saying? So we cracked 160, didn't like 164. Let's pump it back below 160, and actually now we can regain 160 and defend that level again. Maybe. I'm not saying that is the case. I'm not saying that's definitely going to happen, but it is a thought that I'm currently sort of going through my mind a little bit. So if that doesn't happen, so let's say 160 is fine and we actually end up creeping back to 164, we might see the same thing where 164 is the new defensive level. It doesn't really matter, to be honest with you, because I'm still very bullish on yen pairs. I think that realistically that nothing will change until we get the rate hikes. So Bashi, as you said, you're expecting a rate hike by the BOJ. Fine. But then we've got to consider, is the Fed also going to hike? So what we need to avoid, which is absolutely essential, we can't sit here and say, I think the BOJ is gonna raise their rates in the next meeting. We'll see something like this, because then that would be disregarding what we just looked at on the CME Fed Watch tool, with the Fed also expected to hike rates. So in that case, actually the yield gap could potentially just stay the same and dollar yen continues to rise because the carry trade dynamic is still the same. Does that make sense? So we really need to monitor how fast is the BOJ going to hike, if and when they do hike, and also is the Fed going to hike and by how much. So we've got a few different things to pay attention to regarding obviously both central banks, but for now I think we're kind of safe, really. Well, sorry, that's the wrong thing to say. I don't want to say we're safe. You're never theoretically safe in the markets, but you get what I'm saying. I think the whole regime for now is relatively stable until, again, we start getting either a surprise hike or forward guidance, whichever one sort of, comes first potentially. Right. Aussie US dollar hovering around the H4 fib. Yeah, so I closed my Aussie US dollar position, actually. I've got a bad habit. I keep removing my drawings every time I close a trade. I can't remember where it was. I think I was a buyer down here. I caught something along these lines. I think this was, give or take, this was around the trade. Maybe actually a little bit further back, something like this. Anyway, that's not the point. So I did close this position this morning because it was so close to, it actually would have been stopped out. So I trailed my stop below the previous low here. It would have stopped me out realistically if I didn't close it. So I closed it for around 2.3%, roughly. I can't remember exactly what it was. However, would we still want to get in the trade? And the answer to that question is, for me anyway, not really. So I think if we use the edge finder alone, we look at trends, we're keeping our analysis within sort of the simplified framework, which again is the edge finder bullish or bearish? If it is in one of those directions, we look for the trend on the chart. If that lines up as well, we can look to trade. In that case, yes, the trade technically is valid because Aussie US dollar is bullish with a score of 4. The H4 trend is bullish as well. Great, very super simple. But then again, that brings into question the things I've been talking about. Is the Fed going to hike? I think realistically, I don't really want to be short the dollar at the moment. I think I'm leaning more in the neutral to maybe slightly bullish side on the dollar. So that just keeps me away from this slightly. But then on the other hand, the scorecard for Aussie US dollar is actually kind of, lackluster, really. So when we go to the scorecard, what we see is pretty much full alignment with the sentiment readings, which is good, but it's not something I care about too much unless we've got other things aligning, which I'll go into in a second. So technicals are bullish. Seasonality is bearish, actually, but the H4 and daily chart are bullish. Institutional activity, so we can see net positioning actually is neutral, but the week-on-week change, so it means the institutions added more long positions to the Australian dollar compared to the US dollar, so that's bullish. Retail traders are majority short, so that's obviously bullish as a contrarian reading. Great, we figured that out. But the main thing I like to see on the Edge Finder, one of the biggest, for me, the biggest use case for the Edge Finder is actually the 3 pillars down here, which is the 3 main economic categories. So you've got the economic growth, labor market or jobs market, and obviously the inflation data. So I like to see at least 2 out of 3 of these in the same direction as the score. So in this case, we've obviously got the bullish reading, which is 4. That's great. Economic growth is bullish. Fine. Okay, cool. Labor market, however, is completely neutral. There is nothing here. It's a score of 0. Then inflation is -2. So realistically, if I was trading Aussie US dollar, the only real thing I could rely on is institutional data and economic growth, whilst inflation is working against me and there is no job market support. So I don't like it. The composite of this just doesn't suit the way I trade as a fundamental trader first, not a sentiment trader. So yeah, that's the issue I've got, really. So again, it comes down to how you trade, what you pay attention to, but for me, I don't like it too much. Oh, King of Kings. Sorry, I'm not sure if I said good morning to you, but hello. Good morning, James and A1 crew in chat. Yeah, good morning to you as well. I haven't touched the yen in ages because of all of this, and metals being tricky. Yeah, the metals market is a little bit of a tricky one at the moment, because again, the fundamental data, so the economic indicators, are bullish for gold. So if we go back, not go back, but if we open the gold scorecard, we've got the jobs markets that are bullish, inflation's neutral, but that's okay. Economic growth is bullish. So that goes back to what I was saying. We've got 2 out of the 3 that are in the direction. Fantastic. COT data is bullish. Seasonality is bearish. Crowd sentiment is bullish as well. So we've got actually quite a good composite here for gold, which again is fine. So that is very supportive for a gold long idea. And, I'm kind of bouncing back and forth between ideas. I'm making a bullish case at the moment, and I've already made my bearish case, which is where I do actually lean. So we had the death cross, golden cross, whatever, with the 250 EMAs here. When we came out to this bullish trend, obviously this was during the crash, if you will, in gold. We've now recently crossed back to being in a bullish trend. We've got the bullish edge finder score. So there is actually an idea that gold could bounce off these moving averages. That is something I pay attention to when we have an EMA cross. Oftentimes we will pull back to the EMA cross and then continue. Not every time. I don't have the stats for it. It's just a thing, a behavior I noticed. So it's something that I do expect from time to time. Then if we draw the fib from the low of the range, or the recent low of the range, to the high, this does line up with the fib zone. So again, we do have the idea of being a buyer in gold. I'm not saying that it's completely washed away, but again, as I said earlier, the thing that's really putting me off buying gold is just the fact that yields are continuing to move higher. Rate hikes are getting priced back into the markets. It's just, I've just got a bad feeling, really. So again, it depends what you pay attention to, the way you trade, so on and so on, as I say all the time. But this is just my view at the moment. Again, I do think there are some serious headwinds. I'm actually just going to make my video public. There we go. So I've made a full video. It's really annoying, actually. For some reason, YouTube won't add mid-rolls to my videos, so I don't really get paid for my YouTube videos, but that's okay. Okay, let me just catch up with the chat really quick. Please analyze GPAUD and EuroCAD. Sure thing, no problem. I'll just get rid of all of that. On gold, if we draw the fib from the low to the high, price is close to 50%, it could bounce or it might not. That's exactly it. It could or it could not. It's got to do one of the two. How could we enter long GP NZD? H4 EMAs still are bearish and the edge finder +5. We can take a look at pound New Zealand in a minute. I'm buying gold once the price gets above the monthly open. I think that's a good criteria to have. I like it. US economic data was in summer vacation and it starts improving again when people come back to work. I don't know. I mean, what improvement are you talking about? I suppose it depends really what you look at. I don't see really any improvement, but we'll see. So what are we doing? Oh, yes. So pound Aussie. Let's see what's going on here first. Then we'll move on to Euro CAD. And then I think Christoph asked for pound New Zealand. So we'll go into that one as well. Wait, so hold on. Sorry, that's not pound New Zealand. Pound Aussie is what I wanted. Pound Aussie. So score of 1. Really nothing that's piquing interest here on a fundamental side. So I'm going to skip that. I'm going into this with neutral bias. So I'm going to have to just go off technicals in this case. What do we see here? So the monthly, technically bullish with the moving averages, but price action wise, not really at all. The weekly actually looks like it's about to flip bullish with the moving averages after being really, about to flip bearish after being bullish for many years. So that's something to pay attention to. Daily timeframes bearish down here. Yeah, okay. So I'll be honest, by default, I would have to look towards the short side. So on the H4, we've got a really nice level of previous support down here. If we take the fib from the high to the low, okay, maybe there's an idea here. Now, as I said, I'm a fundamental trader, so this isn't a trade I would take personally, but I see a technical setup here. So there's two options. Either we've got this option right here where we could look for, again, this isn't financial advice, I'm talking completely hypothetically, could look for an entry at market price, really. You know, we've already rejected the 50% retracement, sort of the 50 moving average as well. So that's an idea. But I think I'd rather wait to see if price could come back up towards the 61.8% level, retest the previous structure on the left, you know, the previous support. So we've got the break retest idea into the fib and then a continuation lower. So I think this is how I would actually approach the market. I wouldn't really want to be a seller at market price. So yeah, I'd rather just wait for the retest of this level into the fib zone or the fib level, and then see if we can get the rejection. What was the next one? Euro CAD. Oh, didn't mean to do that. Euro CAD here. Again, I don't think there's anything on the edge finder for Euro CAD. So it's -3, so slight bearish lean. We do have actually economic growth and jobs markets bearish. So that could be enough. Inflation data is bullish, but only slightly with a score of 1. Retail are long as well. So actually, I don't mind this, even though the edge finder is technically neutral. I think there's definitely maybe an idea here. Definitely maybe. Great English. So what do we see? So the weekly is showing no trend. Well, sorry, it is in a bullish trend, but in terms of the price action, it's just kind of choppy and sideways. The daily is also choppy and sideways. There's not really anything I can do there. H4, yeah, I'll be honest, there's really nothing I can do on EuroCAD. So although on a fundamental view, I would lean to the bearish side, technically speaking, there's just nothing. The execution time frame of H4, or my execution time frame of the H4 is choppy. There's no direction. The daily is slightly bullish, but there's nothing I can do there. There is nowhere for me to draw the fib. The weekly is pretty flat. The monthly isn't really telling me much either. So unfortunately, I can't really give you much on this market. So next up, Christoph asked for pound New Zealand. So let's see what we've got here. Oh, actually, on a technical side, short position here looks really attractive. You know, we've come up to the 200 moving average, shown a little bit of a rejection within the fib zone from the high to the low. From a trend following perspective on the H4, this looks really nice. But we'll take a look at what the edge finder is doing. So a score of 5. We do have economic growth and inflation that's bullish. That's fine. Retail is majority long. Okay. So yeah, I mean, yeah, I would say, yeah, the bullish lean makes more sense than the bearish side. But I remember we've been covering pound New Zealand, I think, was it yesterday or Friday? Or I can't remember. We've looked at this market previously, though. And the problem I've got is just the daily range. There's no direction. So, you know, we're ping-ponging off the highs. The lows are getting supported as well. Moving averages here are really choppy. So daily time frame, again, just gives me nothing at all. The weekly is really nice and bullish. So that's something to keep in mind. The higher timeframes look quite attractive to be a buyer. H4, as I said, actually looks really good to be a seller. So in a situation like this where I do want to be a buyer, but I just can't do anything because, again, the execution timeframe of H4 is bearish. Obviously, I'm not going to buy into a bearish trend. So what I'd need to see here is a fresh high get printed, take out the previous high, so we create a new higher high, higher low get formed, moving averages cross over, and we start to see, you know, a typical bullish trend with higher highs, higher lows. And again, the moving average cross indicating that the sort of sentiment or the trend has changed. So that could be the idea. On the other hand, you know, if we don't get something like that and we continue lower, maybe looking to be a buyer of the support could also be a pretty simple approach. I don't like to buy supports or sell resistances. It's not my style. But, you know, we've already seen that work here previously, so it could work again, maybe. But again, this is really my best approach. There is nothing that really interests me here at all. I'm kind of more on the trying to force an idea. Ray Beast, I'm good, my friend. How are you? Good to see you. So someone saying gold will pump today. Why? What's making you think that? Just a theory. Let's see. Yeah, we will see. You DM'd me the paper. Let me just have a quick look. I'm not sure where you DM'd me. I'm not seeing any messages on Twitter. Hello, sir. Could you have a look at US dollar CAD? Yes, we can have a look at US dollar CAD and Euro dollar as well. Get rid of this. James, nice haircut. I wish I had a voice like yours. Would be #1 rapper. Gabes, thank you. The problem is I stutter far too much to be a rapper. My brain moves way too quickly. My mouth just can't keep up. I've held buy positions on Euro dollar and pound US dollar since September 31st, 2026 Vietnam time. I am currently quite worried due to the situation involving the US and Iran, as well as the oil market. Okay, we can get onto that. So I'll cover Euro dollar after dollar CAD then, and I'll cover that. They all piled in gold longs, and now they want out. Should see 4,200 level at least. Okay, perfect. Right, so dollar CAD. How could we look at this? Is the edge finder still bearish? Is the question. Let's just see. It is, but it is losing ground. So I'm always saying how I like to use the score over time as a little bit of a confidence indicator. You know, is the score maintaining? Is it increasing? Is it decreasing? What's the direction really of the score over time? So in this case, the score is weakening. So we are currently sat at 5, which is still tradable, but it's not ideal. Institutional activity is bearish, which is nice to see. Week on week change is bearish. Net positioning is bullish. Economic growth and the labor market are bearish. Inflation data is slightly bullish with a score of 2. So essentially, inflation data and jobs market are kind of writing each other off in terms of the score, +2, -2, 0. So that's fine. Economic growth is bearish. So, okay, we do have the bearish idea and bearish sort of reasoning here. So if we take the fib from the low to the high, the daily low and high, by the way, does the fib zone line up? It does line up with previous structure on the left, but this is something I have been watching and something I mentioned previously is this can be a bit misleading for any, if you trade the same way as I do or you're new to this approach. The way I like to use a fib is looking not just at the fib level, but does the fib line up with anything on the left? Is the previous structure there? Can we see a break and retest? Anything like that. In this case, we do have structure here. We had the previous support turned resistance, great. But this level isn't really valid anymore because we've already broken above it and we've broken below it with basically no reaction. We didn't reuse this level again in both situations. So whilst we could use it, it's not ideal. This isn't something that I'm super interested in at this moment. We're also seeing price below the 200 daily moving average. We did see a retest of this and then a closure back below with this bearish candle yesterday. Also rejection of the 50% retracement and this level as well. So I suppose technically the idea is there. I don't really like it. It just seems a bit low quality, but it is there. Technically speaking, we are in a bullish trend here on the daily as well. H4 is nice and bearish, but on the H4, we are kind of seeing, these higher lows getting printed as well. So a little bit of an issue, but again, we are bearish overall. So there could be an idea of going short. I wouldn't be willing to put money on this, to be honest with you. I think, again, it's a little bit of a... Oops, that was the wrong direction. A little bit of a low quality idea, but I think it is there. Again, edge finder is bearish. We do have that fib pullback. The H4 is bearish, so it could be worth it. But yeah, it's a little bit of a cheaper idea, I think. Euro dollar. So What do we want to do with euro dollar? Let's just first of all do, again, a checkup on the edge finder. Where are we sitting? So we've gone back to neutral. So what we can see, euro dollar has been either bullish or very bullish for quite a long time, actually. Basically, since the start of the score over time, obviously it's look back window. So the fact it's dropped off now just 2, and also the things I was mentioning earlier with obviously the Fed rate hikes getting priced in, yields are elevated as well. I'm not interested really in shorting the dollar. So being a buyer of euro dollar at the moment to me just doesn't seem worthwhile. It's just actually a low quality trade in my opinion at this moment. So if the dollar is weakening, if the dollar is strengthening, inherently we're also going to see the euro weaken. Excuse me, sorry about that. So I do think maybe being short could be the play. Now, this brings into question the thing I've been talking about. So some of you who have been here for the past couple of weeks will remember that I've been looking at this monthly pattern where we come up, we create these lower highs, and then each time, eventually, we can have the sell-off to the downside. Obviously, sell-off to the downside. We're also in this monthly bearish trend. You can see the 200 moving average above the 50. So something I was playing off a couple of weeks ago was actually trying to sell euro dollar during this period, looking for that continuation down towards parity. Not saying euro dollar will go to parity, just in that direction towards parity at some point. So maybe with the Fed's slight pivots being hawkish, and again, the elevated yields, it could be an idea that maybe euro dollar is in a situation where taking some short positions could be valid. Now, another thing to back that up actually is seasonality. So if we go to seasonality scanners, we go to annual scanners, and we isolate euro dollar. I'll just type it in here. We can see basically, I mean, this is the 10-year, but it also reflects on the 15 and 5-year. Euro dollar does have a significantly bearish period, basically from now into the end of the year. Slight pickup actually in December, but either way, you get what I'm saying, basically into the end of the year. So that could be an idea that we might actually be in a situation now where going short euro dollar preemptively could be quite a good play. Now, how could we maybe deal? There's no fib. Yeah, so I'm just thinking here. So I don't think actually being short right now is the best play. I'm not saying that, but I think watching maybe for either the euro dollar to flip bearish on the edge finder, some sort of technical setup, something to develop to actually trigger a short position could be the way to go. As things stand right now, though, I would lean more towards just being neutral. I'm not interested in being a seller. The H4 is bullish. The daily actually isn't really doing much. We are a little bit choppy on the daily, and the edge finder is neutral. So at the moment, there's nothing to trigger me into a buy. There's nothing to trigger me into a sell. But I am prepared to be short when the catalyst comes. Again, that could either be technically, in that case, I could go for a DCA short approach, or it could be fundamentally, in which case I could go for more of a swing approach. Sent you a message on James LNE. What, on Twitter or what? Because I don't, whatever, I'll check after stream. All right, no problem. Aussie US dollar was GOI. I'm not sure what that means. My theory about better than expected US economic data this week, like I said, people was on vacation. It could happen. I mean, it wouldn't surprise me. Again, we've had the Fed rate hikes getting priced in. The dollar is still, let me just get rid of all of this. The dollar is still in its point where it could have a new bullish cycle. So I kind of stopped talking about this for a little while, but it is still absolutely valid. Like this idea, when we get down to the trend line, we have these bullish runs. So if, well, actually, let me just redraw this. So you can draw it kind of, multiple different ways, but each way it kind of has the same effect, like this. So every time we come down to some sort of trend line, whichever one you use, you can see we have these bullish runs. So now the question is the dollar going to have the new bullish run? And my idea when we started reapproaching 102 was actually this probably is the start, which obviously was the wrong idea. That didn't play out at all. But if we do end up getting, the labor data improving, we've got NFP and unemployment coming up, and also I think we've got average hourly earnings coming up as well, and the Fed again is seeing rate hikes getting priced in with elevated yields. This could be maybe the new opportunity or the second opportunity really for the dollar to actually begin a new run towards 105. So yeah, I can't remember where I was going with that. I'm not sure why I started talking about it. Oh yes, you were talking about the better than expected data. So yeah, that could be the catalyst, actually, digital content. If we do get that, pop in data that the markets haven't priced in, yeah, we probably, and I don't know what the right word is, possibly, I think is the best way of saying that, possibly start that new bullish cycle. Where did this come from? I don't remember adding a Bollinger Band. Okay. Is your phone trading view working for you guys? I don't know. Can't answer that. My phone is currently used as a webcam. What about Aussie US dollar? We did look at Aussie US dollar. I do like the Australian dollar. I'm still pretty bullish on it. I don't really have a reason to flip my bias on the Aussie dollar at the moment. I'm not massively bullish. It's not a case of I'm trying to accumulate Australian dollars, but it's not something I'm that interested in being a short on. So on paper, again, as I was saying earlier, it looks quite good. So if we go back to the top setups, we do see Aussie US dollar is bullish, but it's only got a score of 4. Something we looked at was obviously the composite of this score. So when we go into the score, that's the wrong market, sorry. When we go onto the scorecard, we can actually see what's making up this positive 4. Now, there's a few things here. I don't trade markets that have a 4 or -4 score on the Edge Finder because it's far too close to neutral. It only takes one day to change to flip it back to being a neutral market. I need really a minimum of 5 or -5, and that way I'm a little bit more safe in the direction or the reading. So that's the first problem here. It's 4. I don't like 4. Economic. Sorry, guys. For some reason, I just connected to a voice channel on Discord. I don't know where it was. I've got no idea, but hopefully the audio is back. Okay. So what I was saying, the 3 pillars here, the economic growth, labor market, inflation data, they're too mixed. So jobs obviously neutral, labor market's neutral, inflation is -2, but economic growth is +2. They essentially cancel each other out in terms of the score, 2 take away 2, 0. So that leaves me with the 3 top scores, which I don't really pay attention to unless they are lining up with the 3 pillars. In this case, we've got bullish technicals, bullish COT data, and bullish sentiment score. I'm not a sentiment trader. I'm a fundamental trader, so this doesn't mean much. And the fact that this is pretty much all that's driving the score, again, because the economic growth and inflation data are writing each other out, means that I don't have a bias here. This actually, to me, is more of a neutral reading. So in that case, what can we do? Well, the weekly time frame is bullish, the daily is bullish, and the H4 is bullish. So I guess you've got 2 options, really. Either you would stay away from the market, again, for the same reasons I'm staying away, or you would look to be a buyer because the trend is bullish, and technically, again, the Edge Finder is bullish too. Now, again, to be super clear, I'm not being a buyer. I've got no interest in rebuying into this market. But if I was, the way I would go for it is drawing the fib from the daily low to the daily high, looking for a revisitation of this level of structure. At the previous low here, we've then broken it, a little bit of resistance there, looking for a retest of this level into the fib zone, still continuing this uptrend, a rejection and continuation to the upside. That's kind of all I've got. But again, it's not something I'm actually interested in. James, James, I'm long short-term US dollar CAD. What do you think? It's tricky. So the Edge Finder is bearish, as we've been discussing. The Edge Finder is not looking good for the US dollar CAD. However, I actually quite like the idea of being a buyer. So what we've got in the weekly is a bullish trend. We created the higher low here. I quite like that. Higher high as well. Bullish trend to the 250 moving averages. That's great. Monthly, also bullish here with the 250 moving averages. The 50 monthly EMA acting as support. That's great. The daily technically is still bullish with the moving averages as well. We have broken below, and we are currently retesting the 200 daily. So for me to be interested in being a buyer, I would need to see this daily candle close back above this 200 moving average, and then maybe I could look for a technical momentum trade to the upside. And again, banking on the idea that we might get better data in the US, we might get that Fed rate hike, or at least the expectations getting priced in even further. That could be an idea. But again, on the idea that we were expecting better data and Fed hikes, it might be a little bit too preemptive, a little bit too overconfident on that idea, because obviously we don't have the data yet. So it'd be a bit of a gamble, in my opinion. The H4 as well is also bearish. So I'm not interested in being a buyer yet. But I think, again, if all those cards align, it could be a good opportunity. Thoughts on euro pound? Yeah, I don't think I've got really anything for euro pound. Let's just see. Yeah, I'm fairly sure the edge finder is pretty neutral. Yeah, score of 2. Okay. Yeah, so actually to me, this would be slightly more on the bearish side. Again, because I'm not really paying much attention to the top boxes. The retail sentiment to me, it's not something I care that much about. And again, technicals, it's not a big deal for me. But what we do have is economic growth is bearish, only slightly though. It's only a -1, so it's not a strong score by any means. The labor market's completely neutral. Inflation data also is a -1, so again, not a big reading by any means. So that puts me, yeah, slightly more on a bearish side, but not enough to do anything. So H4 here is really choppy. Again, sideways price action, moving averages side by side. The weekly time frame is technically bullish. Again, 200 is above the 50, but we have broken below. So I would say that's kind of a null sign. I'd need to see either price continue higher or continue lower with a moving average cross. I need to see something actually happen and a clear move with the trend or a change of trend. The daily time frame is bearish as well. Yeah, I suppose all I can see really is that a mean reversion idea. So something that something I point out quite a lot about euro pound is the way it actually behaves, because obviously Europe and the UK are quite correlated. They're right next to each other. Again, their economies are very closely tied. So this isn't a market where really that often you'll see massive rallies with no correction. I mean, it can happen, but not very often. I mean, you can see here, this is a large range, but every time we have these rallies to the upside, we often revert back down. So something to keep in mind. Could we, and what I'm saying by that is, could we actually end up coming back down to these lows? I think it's very possible. So if the edge finder managed to actually solidify a bearish score, again, with this daily bearish trend and this previous structure on the left, and we saw a pullback into this level, retesting the previous lows or previous support, and then a rejection continuation lower, again, with the edge finder score as a nice confluence or trigger, that could be a good play. But again, the edge finder doesn't support this right now. This is more of a, in a perfect world type idea. But yeah, at the moment, I really don't have anything for you. How could we enter short on the Russell and Dow? Both bearish on the edge finder, are they? I swear they went back to neutral. They reappeared. You are right. Yeah, the Russell's gone back to being very bearish, which is interesting because I was saying yesterday the Russell was neutral it was bearish, then went neutral, and it seems to have just collapsed on score. Same thing with the Dow, actually. Both lost 2 points of score over the past 24 hours, which is interesting. So actually, yeah, you are right, Christoph. I didn't even notice that. We could maybe look for something in those markets. I do quite like the idea. So the Russell, how could we look for a trade here? Let's see. The daily is very bullish. That is something to keep in mind. And obviously, we should all be aware that shorting the index markets like the S&P, Nasdaq, Russell, DAX, whatever it may be, inherently is very hard because the natural drift is to the upside. So pretty much by default, you're going to be counter trend trading. Obviously, lower timeframes like the H4, the H1, maybe even the daily could line up bearish. Weekly, monthly, you're pretty much always going to be against the trend there if you are shorting. So what I see here is actually really, really nice. I really like this H4 time frame. We've got a really nice, clean level of structure on the left here. Actually, I've not drawn that great, but you hopefully can see what I'm doing here. Obviously, we've got previous resistance, broken, retested, and then used as support. We've got the moving averages crossed here, or beginning to cross on the H4 as well, indicating we're now out of this bullish trend and starting a new bearish trend. So it's looking very nice. So if we draw a fib from the high to the low, we don't. Well, actually, I suppose we do. So maybe a short position on 61.8, stop at the previous high, and maybe even no take profit. Again, it depends really on the forward guidance, US data and things, but the Russell, well, actually US markets could have maybe a significantly larger downside than just an average swing trade that we might look for. I'm not saying that is going to happen, by the way, but I wouldn't mind positioning for that with a trailing stop and no hard take profit. So in this case, I would be looking for a pullback into the 61.8% level because it lines up with this previous structure on the left. Again, moving averages cross, we could see a pullback into those EMAs and then that continuation lower. So what I'm going to do is add this to my watch list because I do actually really like this idea. So we'll leave that there. What else was there? The Dow. I think the Dow is probably similar, if not the same. Yeah, it's similar, not the same though. So again, higher time frames, weekly, monthly are bullish, daily is bullish as well. H4 is also bullish, and we are coming into this double bottom, actually a really nice level through here that price could see a bit of a rejection off. So how could we play this? I think the way I would want this market to go in order for me to get into a position is a clear of these lows. So we break below, then we come back up, retest into this level. You know, ideally, this also lines up with some sort of fib zone, 50%, 61.8%, or the middle of those two. Either one is fine. And then again, that rejection and continuation lower. So this one would be break, retest, very similar to the Russell, I suppose. So yeah, I think I'm also going to add this to the watch list because I quite like the idea of being short Dow, but I think Russell has a bit more short-term potential in terms of obviously the trend is already established on the Russell. We've already created that new low on the Russell as well. So I think I would prioritize Russell over the Dow for my strategy anyway. Simple, don't short it by the dip. On what KDX? Are you talking about the Dow and the Russell, or are you talking about gold, or what? I'm thinking about scalping US 100 short-term buy. Let's have a look. Short-term buy. I'll be honest, I wouldn't want to be a buyer of this in the short term. I don't really see anything going on. If anything, I would probably more lean towards going short. We've also got the market open coming pretty soon. Yeah, so that's the thing. When we've had a move like this, I would stay away until we've got the market open. Either we get the market open and it continues lower, or it completely corrects, and yes, your buy position could have been in some great money, but it's not a risk I would be willing to take. I'd rather let the market open, let it do whatever it wants to do, settle, and then trade in the direction that that opening session establishes. But yeah, for now, not really anything there for me. I actually need to clear. Oh no, wait, hold on. Sorry, I just remembered. These orange lines are my positions. I completely forgot. And actually that will tell you how small these positions are because I completely forgot I've got them open. I need to add this back onto my open trade list. Yeah, so I'm short on the Nasdaq, and this has been going on for probably 2 or 3 weeks at this point. And as you can see, nothing's really going on. So each orange line is one short position. So I've got 2 positions open, very, very small position sizes. And the idea behind this was at the time, as I said earlier, the Nasdaq was bearish on the Edge Finder. And I do have an overall bearish lean. I've got a little bit of skepticism around AI, tech, valuation, so on and so on. But also now that the market is pricing in those Fed hikes again, maybe I want to double up a little bit, or not double up, but size up a little bit on my short idea and just let it run. But yeah, the idea really in these short positions is actually just to see if it continues lower, I can scale in, add a bit more size. Once the market starts to prove itself, fantastic. If it doesn't work and we actually start creating new highs, I can take a very, very small loss. No harm, no foul. So I quite like I'm still in favor of the short idea I had, but again, they're so small, I completely forgot about them, which is a bit annoying. Luckily, it's not done anything, which is fortunate for me. GBP USD shorts. Yeah, I quite like that idea. But it's kind of the same as what I was talking about earlier on, was it Eurodollar? I think it was Eurodollar, where I just don't think it's in a position yet to do anything. So technically, pound dollar here actually looks really good to be a buyer. We've broken this level. We've come back down for a retest. We've got the bullish trend on the H4. A break and retest idea actually looks like sort of the base case on a technical side, sorry. So that sounds quite nice. But when we check the Edge Finder, I'm fairly sure pound dollar is back to neutral. It is. It got a score of 2. So yeah, there's really not much here that is warranting me into a position. We can also see the score over time has been decreasing quite consistently. And again, we are back into this neutral zone now. So yeah, that makes me a little bit cautious. And again, I am beginning to consider actually pivoting back to being bullish on the dollar. So I wouldn't say being a buyer is a fantastic idea at the moment, although the technicals do look quite nice to be a buyer. I think what I would rather do is wait to see how the data this week comes out. If we can get the break below this level, break below the 200 EMA, some sort of retest into this level, and then a rejection, I might consider a short position at this point. But yeah, that's really all I've got at the moment. Again, that's kind of a bit more forward looking. I need to see quite a lot happen. I need to see price develop. I need to see the data. It's not a short-term idea, I don't think, really. XAU USD. Yeah, we've covered gold quite a bit in this stream already, but I suppose I can do it again. I've got about 10 minutes left. Let me just catch up with the chat. Money's good, mostly traveling. Bashi, gold trading, bro. Oh, you've been on a safari in Kenya. Very nice. Hope you enjoyed. So with gold, there's a couple of different things going on, really. So you've got this, the data, the hard economic data, or the economic indicators, as I should say, are bullish. So if we go to the Edge Finder scorecard for gold, what we can see, we've got a very bullish reading. We've got a score of 7. Fantastic. We want to be buyers. Okay. Jobs market's bullish. Inflation's neutral, but the economic growth is bullish. So the 3 pillars are bullish overall. Institutional activity is bullish. Technicals are bullish. And also the crowd sentiment's bullish. So everything really, except inflation, which is neutral, is in line for us to be buyers. That's great. The problem I've got with gold is I'm not really in a position where I want to be short the dollar. Because, as I've been saying, I'm not going to go into it all again, but yields are going to the upside. The market's pricing in rate hikes again by the Fed. I just don't feel comfortable really going short on the dollar at this point. I've already been shorting the dollar for the past sort of month and a little bit. Aussie US dollar, gold. What else was there? Oh, there was dollar Swiss that didn't work out. But I'm also long the dollar on dollar yen. Anyway, I'm sidelining a little bit here, tangent. But yeah, what I'm trying to say is I'm just not overly confident in gold bullishness at this time. So there is an idea of being a buyer. If we take the fib from the low to the high here, we have seen a rejection off the 50% retracement. We've also seen a rejection here off the 200 EMA. That looks great. The daily time frame also looks really nice on the technical side. We had the EMAs cross. We crossed here and the death cross, golden cross, whatever, into a bearish trend, then very quickly reestablished a bullish trend. And again, the Edge Finder is bullish as well. So I think it depends how you trade. What do you pay attention to? If you're not really a central bank or an interest rates trader, you're more just, Edge Finder's bullish, trend's bullish, I'm going to go. That's cool. I think this is a great idea to be a buyer of gold in that case. But the way I trade does account for fundamentals massively, but really what overrides the fundamentals is the forward guidance, what the market's pricing in, what can we expect from central banks going forwards. And from that, it again kind of sways me away from being short dollar, aka long gold. So yeah, that's all I've got for you really. So if I did want to be a buyer of gold, I don't mind this idea. Again, buying off the 50% retracement of 200 moving average, previous structure on the left looks okay. But as I said, not for me at the moment. I could come back to it. My idea could pivot on Friday. If we get really poor US data, it might re-pique my interest in being a buyer of gold. But yeah, at the moment, I'm just going to wait and see what happens really, and just let the markets do what it wants to do this week. Okay, I think we've actually covered everything. I'm not seeing any more chart requests, which is nice. I think we've done quite a lot in this stream actually. Meter James just focused intraday, but London has been asked for a while. NY 50/50. Interesting. Yeah, I've recently started scalping again. Not much. I think actually I'm 3 for 3. So Friday, Monday, Tuesday. Oh, actually, yeah, today I did take some scalps in London session, which all did quite well, actually, mainly on the DAX. I'm really enjoying trading the DAX, actually, at the minute. It's got really nice price action. But yeah, it's interesting because I stopped scalping. I got really busy. I just didn't have time to sit down on London and New York session and dedicate an hour or two. But I've had a bit more free time over the past couple of days, so I did. And I think it might be a little bit of beginner's luck. It just feels way too easy. And I know that might sound like I'm blowing my own trumpet. Trust me, I'm not. I know scalping is very, very difficult. But all I've been doing is following the trend, putting the VWAPs on a 5-minute time frame on the DAX, going down to the 2 minutes, just following off VWAP projections. And it's just been working so smoothly. But yeah, I'm sure that will come to an end at some point, unfortunately. But yeah. Yeah, Bashi, FX. Yeah, I've not really seen much in the FX markets piqued interest, which actually, I suppose we've got a bit of time so we can go over it. One of the reasons I've got the stock box, because I can diversify a little bit of obviously my scope. I can broaden my horizons, as I've been saying, if it loads. So what I can actually do is show you the NVIDIA trade I'm in, which is a little bit disappointing at the moment. It's not done that much. It started out phenomenally well. So I entered on the 50% pullback, bullish trend. The entry really couldn't have been that much better, really, in terms of the technical setup. It was bread and butter. It's what I love to see. Break, retest, bullish trend into the fib. Perfect. It started out in quite a little bit of drawdown, nothing major. But then we had, I think it was earnings down here. And the pre-market went kind of crazy, opened up here. I was like, wow, stocks is easy. But then since then, it's obviously come back down. Pre-market now is expected to open a bit lower. But yeah, I think stocks is definitely something I'm interested in, but I just need to find some time to really sit down with the stock box and develop a strategy around it. I'm not sure if my FX strategy, again, with trends and fib actually work with stocks or not. I need to go and do a full back testing session. But anyway, I'm starting to yap a little bit, but yeah. So at some point on these streams, we can start going over some stock ideas, but I don't think really many of you are that interested in stocks. Actually, I never really see stock requests. It's mainly FX pairs or gold, maybe some indices as well. Stock trading even worse. Yeah, to be honest, I quite like to get into agricultural commodities, but it's just not a priority at the moment. Simon, what are you saying? Oh, okay, he's going to ball out. Sweet. Okay. So yeah, I think we have pretty much covered everything. I've got 3 minutes left. So just to recap, I'm currently long on dollar yen, still long. I've got these 3 positions to the upside, basically just benefiting from the carry trade dynamic. Really nothing complex going on here. At the time, I was talking about the idea that every time we get these interventions, at least in recent history, we come down to the 200 moving average, or at least towards it on the daily, and then we show a rejection. So that's when I started buying. Super simple idea. Really nothing else to explain there. Gold, as I said, I am still in my long positions on gold. I'm holding this position for now. Actually, no, that's a lie. I closed this position this morning. That was complete fabrication. I don't know why I still thought I was in it. So yeah, I'm not actually in this position anymore. I'm going to leave it just so if it plays out. I might re-enter it if we see a pop back to the upside. But these 3 positions are still active. These are the DCA positions with very small size. I'm going to hold those. Even if gold ends up dipping towards 3,500, for example, I'm still going to hold those trades and continue to add in long positions, very small size as price drops. And then I'm going to this is obviously completely hypothetical. If gold does start dropping to 3,500, for example, I can offset the drawdown from the DCA approaches with short-term swing trades to the downside. So that's the plan. Of course, sounds great, but whether that is actually what will happen, we'll have to see. NVIDIA is actually risk-free at the moment. Stop is at break-even, so whatever happens, happens, but it looks like it's very likely to get stopped at break-even. And I am short on the Nasdaq with, again, 2 very tiny positions. These are more just reference points. If the market does prove itself and does continue bearish, I can add in some more size. If it doesn't work out and for some reason the Nasdaq starts rallying, I can close it for a very small loss. But yeah, that's the only positions I'm in at the moment. I've massively reduced my portfolio so far this week. Aussie New Zealand, I'd quite like to get into a long position, but there's nothing yet, so I'm not even going to bother showing that. Euro dollar, we've already covered. New Zealand US dollar, we did look at yesterday, I think. And I think I was talking about a short position off this fib, if I remember correctly. If not, I did cover this idea in my Sunday video, but it didn't come. I didn't take the trade, so it doesn't really matter too much. Dollar CAD longs, we did discuss this as well. I don't mind the idea, but I need to see something really happen. I need a catalyst within the dollar. So either something to solidify more of a bearish view and continue that edge finder bearish reading, or something to solidify rate hikes by the Fed. It could be, improved labor data. It could be lower unemployment, higher NFP, whatever it may be. Again, some sort of catalyst to really trigger that idea. BX is something I was looking at yesterday, looking for a pullback into the fib. Not going to go over that as a stock. I don't really have time now to pull up the stock box. Russell 2000, we looked at this on stream. So I'm looking for a pullback towards 61.8 into the previous structure for continuation lower. So break. We had the break, looking for a retest into the fib, continuation lower. We've got the moving averages flip bearish, and it's bearish on the edge finder. Looks great. And the same thing here for the Dow. So looking for a break below these previous lows or the support, retest into this level, continuation lower. Ideally, if we draw down the fib from this high to wherever the low is printed, this would be roughly some sort of fib pullback as well. We'll see. Of course, that is very optimistic thinking, but yeah, we'll see. Anyway, Ladies and gentlemen, that brings me to the end of my segment. We now have Alan Perez coming to take over the show. Don't go anywhere. Alan is a fantastic guy and a great trader. So, guys, thank you for being here. I'll see you all tomorrow. Stay safe. Don't get margin called, and enjoy the rest of your days.
Hey traders, don't go anywhere. The show will be right back. I just wanted to tell you about today's sponsor, that is 8cap. 8cap is currently offering traders outside of the United States a huge welcome bonus when you create a new account using the link that is being dropped in a live stream chat or in the description down below. When you create a new account using our referral link, they'll give you a 20% deposit bonus to your new trading account. For traders who prefer trading on a brokerage rather than a prop firm, this is a great option in which you get a nice little boost to your new trading account. But I do also want to disclaim that terms and conditions do apply to this, so please see the full details using the link that's just been dropped in the live stream chat. Alternatively, you can scan the QR code that you see on your screen right now if you're watching from a desktop or a TV. 8cap has several regulations worldwide and is a very well-known CFD and Forex brokerage. So check out 8cap if you're interested in switching over and taking advantage of this really generous welcome bonus they are offering our subscribers now. As always with any sponsor, please do your due diligence to make sure that this is in fact the right brokerage for you and your trading style as well as your own risk tolerances. Thanks to 8cap for sponsoring today's content. Now back to the show.
Good morning, everyone. Happy Tuesday. It is already Tuesday. Hope you guys are doing fantastic. Good to see all of the regulars out there. Bashy, ball out. Good to see you guys. What a lovely morning. It seems like volatility is certainly picking back up here. You have gold under deep pressure. You have the VIX starting to wake up, maybe up 6%, still in the teens, but it is green on the day. You have the Nasdaq here down 1.2%. You have lots of movement going on. I am looking at the yields too. I definitely noticed that. That could definitely be problematic. Looking at the 2-year, sorry, it is up very, very high here, very stubborn, actually getting to this whole Middle East war high. So getting very close to it. The 10-year yield is starting to break out here, which this is what I'm looking at here. This is kind of like the line in the sand for me in the near term, right? So you have, this is the US 10-year yield, and you have, or the ZBs as we called it, the Zimbabwe. If you were here yesterday, you know what we're talking about. This is the ZB here, or the ZG, one of the two. But you can see that we've been kind of trading within a range here. And you've kind of capped advances here when it comes to the 10-year yield here many times, 1, 2, 3 times. So I'm curious to see if this is a similar situation. If you have a breakout level and you start to see the 10-year yield near 5%, that to me is like, okay, we probably take the whole dollar short trade off the table. You take, you probably see some pressure in equities. You probably see gold lower. So this chart here is starting to be, it was already very important, but it's starting to be one of the charts that I look at primarily. So the US 10-year yield creeping up like that is not a good sign. The long end of the curve as well, completely now absorbing the whole Scott Bessent candle, which was this one right here. Scott Bessent went and announced his bond buybacks. You saw a really solid red candle there. It was really good. You saw lots of dollar weakness, gold up, Bitcoin up. But now you're starting to see the market just recover all of those losses there. Again, making or close to making new highs, it can be very problematic if you start to continue trending in that direction. Because of that, you have yields higher, right? You have gold lower, obviously. So gold lower here, you're getting close to that 50% retracement level. You're still within an upward trend. So I'm not here to say like, I'm not going to doomsday and say like, oh, the trade is over with. Definitely not. But it's definitely some signs that we have to be looking at, right? So right here, you can see that you still have the 50% and the 61.8% retracement level where gold can tap into and still be within an upward trend. But if you start to lose the 61.8 and continue lower, then likely you probably just revisit the kind of the bottom end of the range here, which is at 3,900 to 4,000 area. So that's what I'm looking at. Definitely the trade is starting to get a little bit more cloudy. Same thing with silver, right? You're now starting to continue that decline there. You broke this level of support here. So this was previous resistance, turned support. It did not hold well. So you still have like this upward trend line here that I'm looking at as well. So if you see this right here, you still have that upward trend line. If we break below it, then you likely see more pressure down the line. And then oil. So we talked about this yesterday. I told you guys how I'm very much looking at the price of oil and how I needed to stay below this level of resistance right here and this bearish trend line, right? And oil is not doing that. So right now it is starting to break out. And so that only makes the gold long trade even more trickier. So with all that being said, I'm watching those charts. They're doing what they're not supposed to do in terms of being long gold. And because of that, I'm going to sit on my hands and wait. Same thing goes for anything else related. So I wanted to, because I got stopped out of dollar Swiss. I got stopped out of, well, not dollar CAD. I have dollar CAD and euro dollar long. I got stopped out of dollar Swiss. I was looking for, like re-enter opportunities or way I can, add some size. But because of that, my conviction of the trade starts to kind of, I question the integrity of the downward trend in the dollar, right? As you're seeing new things in the market. So I'm going to be watching that. You have volatility again picking up here. So I'm going to be looking at that as well. You do have some very important figures coming up on the pipeline here. Didn't mean to do that. Very important figures here on the pipeline for the market. You have, let's go to Forex Factory. Let me show you what I'm talking about. We go to, just go the whole week here. We have ISM manufacturing today, this morning. That's going to be good for growth. We'll see what happens there. If it starts to miss, then likely you see some dollar weakness. But if it's strengthening, then you see some optimism around the growth picture. Then you have ADP non-farm employment change on Wednesday, which is usually like a forward-looking indicator for the NFP on Friday. So we'll see how that one goes. You have unemployment claims and ISM services, which I don't know why ISM services is orange and manufacturing is red. Like services is the bigger component when it comes to that GDP number. So I don't know why that is. I don't know if you guys have any thoughts on that, questions on that. But you have ISM services on Thursday, and then you also have the NFP and unemployment rate on Friday, which I think that's going to be like the big one here that markets are looking for. Because remember, we've had a string of weakening numbers for NFP. You can also not forget that right before the Friday Jackson Hole Symposium speech, you had NFP yearly revisions come out that came in worse than expected. So definitely cannot ignore that. In fact, like the reaction was like dollar mega weakness in the dollar right before the Jackson Hole meeting, right? And then as war started becoming more hawkish and such, it started to turn around. So I'm looking at CME Fed Watch tool to see where things kind of sit. Yesterday, we were looking at one rate hike in December and holding from there. And we'll see as yields are higher today. I wonder if that's starting to shift. And no, it's still the case. That's interesting. Still the case. Really, nothing has moved here. You have one rate hike in December, and that's it. So we'll see. We'll see. I'm going to look at the chat here, guys, to see what you guys are doing. Boss says Alan knows. Good morning, all of you guys. Volatility is going wild on EU. Alan, can you analyze it on a weekly chart and see how much dead money it's been? It's basically saying that currencies have been kind of stagnating and flat for a long time. And if you look at it, yes, you can see that probably the mean of this chart is going to be right around here. Oh, let me turn this yellow. The mean of this chart right here in recent times is probably right here. Exactly where price is right now. So, Ballout, you are correct in that. ZBNZNL, yes, that was funny. That was funny yesterday. Buying back bonds because nations are pulling their money out is almost as bad as Americans paying their mortgage on credit cards. Let's see. Alan, please discuss why EU has been manipulated lately with the crazy movement around 5 pips a day. Well, 5 pips a day ball out, that is very abnormal. Usually, I try to go to like the 1 second chart, and then I try to scout for like half a pip a day. To me, that's like a really big move. So to us to go from half a pip a day to 5 pips a day, I mean, that is a big jump there. But yeah, I'm trading the 1 second chart here. I see lots and lots of gaps here, fair value gaps or whatever you want to call it. I mean, like every candle is presenting some sort of a gap here. This fair value gap has been filled. You can see right here we had like this liquidity sweep, but we still have lots of unfilled gaps here on the 1 second chart. So I'm gonna try to catch like a half a pip move. and I'll be good for the day. Yeah. Just joking, guys. I sit on stream and I swear there's zero movement. It's crazy, man, because like the markets really have been very quiet. There's like was it Nick that said it? But like basically the kind of new wave of volatility is like you have this moment in time, right? This is like the previous, you can call this, let's call it like this. This is the previous kind of event, right? Let's call this Jackson Hole Symposium. And then you have this one right here, which represents NFP. And basically what happens is you have volatility and movement in the market is very, very quiet, very, very quiet, because there's no forward guidance, nothing like that. And then it just shoots up at the event. And then it also dies down. And then it's very, very quiet for the next event. And then when the next event approaches, you have volatility just shoot up higher. So I think that's probably going to be the regime, the volatility regime that we kind of operate under. But we are seeing a spike in volatility today, even though we don't have much going on today. Like you have the next thing, which is NFP. That's like what the market's looking for. Yet you're seeing some movement today. You're not in gold? No, I'm definitely not in gold, man. I am definitely not in gold after seeing the oil chart break out of this trend line here and this resistance. Don't want to be long gold if oil is breaking out. I don't know how far it will go, and I don't know how long it would stay elevated. That's one question there, two questions. And I'm looking at the 10-year yield, or yields across the board. The whole yield curve is up on the day. So that's definitely making me hesitate on gold longs. Not to say that the upward trend is still intact. You still have the 50 and the 61.8 below. But I will say that that makes me question that. Brizzo, you're funny. I just saw your comment. No, you know what? Do I have a brother from Nigeria here? I am not from Nigeria. Born here in the U.S. Yeah, they've been quiet. Pound dollar shorts. Let's look at pound dollar shorts. So for me, I still want to be short dollar. So I know I just said like yields are elevated, oil is elevated. Yes, and yes, and yes. Definitely that is not something to be ignored. However, from like a technical perspective, the pound dollar is still within an upward trend, right? Like if you measure this move from the recent low to the recent high on the fib, you're barely at the 38.2. You still have the 50 and the 61.8. So, technically here, the overall trend is likely to the upside. Now, do we see some short-term weakness in the pound if we're getting a pullback? Absolutely, but that doesn't mean I'm going to short the pound. In fact, if I go over to the Edge Finder, which is a tool that I use, a tool that we all use here on the live stream and within the A1 community, I'm sure that it's still bullish right now, if I'm not mistaken. And that's because you have the fundamentals, the technicals, and sentiment all aligned in that. And so if we go to majors only here and we just look at the pairs, you can actually see that pound is actually slightly neutral here. Now at a 2 reading instead of you need a 4 reading for it to be bullish. So that is also different. And you're seeing a lot of changes here in the actual all of the major currencies. You have dollar CAD is still bearish, but remember, it was very bearish. Dollar Swiss is still bearish, but it was very bearish at one point. Dollar yen's neutral has been like that for a while. And then Aussie, pound, euro, Kiwi were all very bullish readings, and now they're just either neutral or just bullish. So definitely going to keep an eye on that. Okay, that definitely does make me look at things differently, slightly. So we'll see what happens. We'll see what happens. I'm not really too enticed. Again, when you have like these questions up in the air, like are yields going to remain elevated? Is oil going to remain elevated? Things like that, or like NFP, right down the line in a couple days. That right there, all of those open-ended questions that are unanswered, just tells me I should probably sit on my hands and just wait for more clarity. Like there's no reason for me to just see any sign of dollar weakness here or dollar strength, I'm sorry, and just jump the gun. Like, again, you don't know what's going to happen with yields. I don't know what's going to happen with oil. I need to see structure change for me to be like, okay, the trend is now changing. Now, does that mean that I catch the whole entire move or I'm at the top of the market? No, but No one ever is like that. If you're a buyer, no one is ever buying the absolute bottom of the market ever consistently. If you're a seller, no one is ever selling the top of the market all the time consistently. That does not exist. Okay. There's no way you can bottom tick or top tick the market unless you're lucky. So with that, I always know that I'm missing a piece of the pie, but I'm waiting for structure to change. And I would rather be in that position for sure. What do you think about short gold for the short term? So same thing, man. No, like I'm not going to short gold just because I'm seeing some slight weakness. Like I'm still bullish on gold. Um, right? You're just seeing a pullback. That's all. Like this thing can shoot up any moment. You never know, right? So that's why I don't want to short it. Eric says, bro, you guys went from all paths lead to gold higher to now this I understand no trade is 100% guaranteed, but it's funny to see it in real time. But you're missing a piece, Eric. Well, I can speak for myself here. We said all paths lead to gold higher, right? Or most scenarios lead to gold higher. I admit, hand up in the sky, I did say that. But I never said that gold was going to go higher in a straight line, right? You can have pullbacks in an upward trend market. So I still think that gold wins in a lot of scenarios. Like if you have yields lower, and this is exactly what I have been saying verbatim in the part of the streams. If gold is going higher because of lower yields, that makes sense. But gold can also go higher if the market is pricing in risk on the long end of the yield curve, right? You can have like this debasement trade type situation where gold continues to go higher. But I never said the actual path that gold was going to follow. Like I didn't say that it was going to go like this with zero pullback or very little pullbacks. I still think that's the case. But again, a pullback is very necessary and the trend is still with intact. You haven't hit the 50 or the 61.8% retracement level, right? So like, if anything, I am well receptive of deeper pullbacks. As long as you stall out at the 61.8, the trend is still upwards. So yeah. And by the way, I would never, ever, ever say that any asset is going to hit a certain price target with a specific path. I will never say that because gold can hit, let's say gold hits 4,900, right? One day it can go like this. It can go like this. It can go like this, super slow. There is so many different paths it can take. And for me to say that I know which path it's going to be, there's no way. There's really no way. Let's see the chat here. And I hope that made sense, Eric. And my apologies if I went on a little bit tangent. My bad, man. But for the people watching, I know from a beginner standpoint or from someone that's just genuinely interested in what the price is, like they definitely look for kind of answers on the live stream. And I'm just saying this, like, anyone that you watch, whether it be myself, anyone on the A1 team, or maybe from other live streams, like one red flag is like certainty in the markets, like speaking in definite terms, like gold is going to do this. I would just kind of like be careful with that and shy away from it. So, I'm not trying to bash anyone here or anything or ridicule for thinking or asking those questions because I really think that there's no bad questions. Like I've had very stupid questions, right? Don't get me wrong. I've definitely done that before. So yeah. If the Fed hikes the rates, do you think it would affect the long-term bullish trend for gold or will it start a downtrend? That's a very, very good question. I would say that if the Fed does a one insurance hike and the market knows that and sees that, like if the Fed hikes just one time for insurance sakes, but then they know that they're probably going to be neutral or look to start cutting and the chance they get, then I think that, then I think that the gold long trend is like short term, disrupted, but I don't think that it's gone for good. But if you have, going into a rate hike cycle where you have consecutive rate hikes on the table on the horizon, then at that point, yes, you probably start to question the kind of gold trade to the long side. So that's kind of what I would say about that. So we'll see. Right now, CME Fed Watch tool is pricing in the first, which is one rate hike and holding, right? So you have one rate hike in December of 2026. Oops, let me make this pink here. One rate hike in 2026, and you hold from here. But if you see this chart, CME Fed Watch tool, and it starts to look like this, where you have one rate hike, then another rate hike, then another rate hike. That right there is more tilting into like the rate hike cycle. And at that point, yes, you start to question kind of like what's going on with rates. Gold probably doesn't perform the best in that scenario. And so, yeah, but right now you're seeing the first one, which is just one rate hike and hold. But again, the bond market is telling you a whole different story. You have, and that's why I'm kind of sitting on my hands here, not, jumping the gun on anything. You have CME Fed Watch tool, Fed Fund Features telling you one thing, but then you have like the 10-year, which is on track to break out higher. And if it breaks out higher, well, that's definitely not good for rate stories, right? If you are a dovish person out there, if you're betting on Fed to cut rates, but you're seeing yields across the board, like the short and the long end of the curve, continue higher, breaking out here, that's like a big question mark, right? That's something that you got to kind of watch out for and look at. So we'll see. I think the biggest driver of this right now is likely oil. I know we had some fresh escalations out there. And to be honest with you guys, I haven't looked at what's going on today. So let me just refresh here and see if anything new in the Middle East stuff has developed. I don't think so. Euro CPI came in flat. Okay, that's cool. UK manufacturing 51.7, slightly better. Let's see. Nothing on Iran though. I know there was some back and forth yesterday and Sunday night, I believe. Okay, yeah, nothing. But I know that like the biggest culprit right now that's probably driving this is going to be oil breaking out higher, right? For the longest time, it's been kind of respecting this bearish trend line, if you will, right? Price has just been kind of staying below here, trending lower, right? Every time we tap into this or get near it, we kind of hold off. Now you're starting to see a breakout above. You also had this level here, which was like support during the war, turned resistance at one point. That is also starting to fail as well. So again, like if you see oil higher, elevated for higher, and it stays there, then that brings the question of, are we going to have inflation come back, right? And in that case, the Fed does need to do what it needs to do, which is start to raise rates, right? Or at least one insurance rate hike. And also, too, what would make that kind of decision a lot more clear is this week's NFP report, right? So like the Fed has a dual mandate, which is maximum employment and stable prices. And right now, I've been thinking under the framework where like you've had CPI, PPI, you've had all of these inflation prints kind of coming cooler. You've also had weaker job numbers, right? So my kind of framework, my thought process was like, if you have inflation kind of taking care of itself and you see the labor market starting to weaken, then perhaps the Fed can target the labor market, that part of the dual mandate, and cut interest rates or at least stay neutral. But now, if you have oil prices elevated, then the question becomes like, okay, does inflation start to run hot again? And let's say today's or this week's NFP report comes in really, really strong. Well, then that whole thought process that I had, like the Fed needs to like hold or cut rates to save the labor market, that also goes out the window too a little bit. So you could very well be at a pivot point. But again, it's too early. Just look at the market. It's still very early on in this shift. So that's why I'm staying on my hands. But it's definitely good to kind of know how you would trade, where you would trade if either one happens, right? So if you have kind of like this Fed put situation, you'll start to come lower, go lower, and you have the NFP report slightly neutral to weak, right? Then likely I'm a buyer of dips on gold. If you start to see the opposite end of the spectrum, you have dollar strength come back into the picture, right? Likely, I like being a buyer of dollar yen, especially if there is some interventions that can get me some very quick low prices. I would love to build a position here over time, right? Get some dollar yen here going, build a position, get some positive swaps as well along the way, right? Until that rate differential between US and Japan starts to get neutralized, which to me, I think that's going to take some time. It's not something that happens overnight. So I like dollar yen. If you have strong dollar, I also like I also like dollar Swiss as well here. If you were to start to break out of this big level of resistance here, that's also a good trade for me. Let's see, euro dollar may be a position that I take as well. There's lots of different ways I can go about it, but just understanding kind of like where you would deploy would be a good one. Bitcoin here, I'm not a trader of Bitcoin by any means, nor am I an expert, but I am watching this because it is holding its own ground here. And whenever it did start to pop off, it was after that like Scott Bessent bond buyback situation where you had yields lower. So it was definitely very sensitive and very reactive to yields. So I'm curious to see like if you have yields continuing to skyrocket, does this move start to get walked back? And if so, I think you have pretty solid risk to reward at this level of resistance here. You can see that Bitcoin has been kind of trading in a range, and it could definitely solidify itself as a range. So I like the risk to reward here, like short here, stop above structure, maybe target the 200-day, because you could look at it like this, right? Like if you want to be bullish Bitcoin, you could say that a pullback into the 61.8 still holds the integrity of the new upward trend, right? So like if I have risk defined right here, boom, enter here, stop here, I could still target at 61.8 and the bull side is still correct, right? And then if it fails, then I can just move my take profit to over here. So that's one thing I have kind of open there. Again, looking to see how high yields go and how sensitive this thing is. But right now, as you have yields higher, you do have Bitcoin still kind of holding its ground there. So I'm looking at that one too. Could be a contender, but we will see. We will see. Nasdaq here is pulling back here. I think it's tech that's leading the way down. Let's see. Tech, yeah, it's tech leading the way down. As far as this one goes, I'm not buying Nasdaq for swing trades at these prices. And look, I may be waiting for months, but I need a bigger corrective move. I'm not gonna buy a market that's just slowly grinding higher when you have yields grinding higher, where you have all of this like spending going on and question marks around that. I would rather buy that here. So I may be just waiting forever, but who knows? I'd rather wait and be patient than just like get stuck in a position or have to like find my way out of here if suddenly I buy at this level here and you see just the market start to tank. That would be not a very good scenario for me. Let's see what else do we got here. I think I went top down, guys. If you guys have any assets that you want me to go over, feel free to drop that into the chat. I can do maybe a couple here before I pivot out. Let's see. What is the score and edge finder for gold right now? Okay, let me look at that real quick. Let's go majors. We will metals only. It's still very bullish. Silver is now in neutral camp, and copper and platinum are copper's neutral, platinum's bearish. So gold is still bullish again. So like a pullback, right, is very much normal. Very, very normal. Is it an aggressive pullback? Maybe, but a pullback is still normal, right? It's well received. Zinc futures, you guys are funny. AUD Aussie Kiwi. Okay, let's look at Aussie Kiwi here. Let's go to the miners only, see what the edge finder is telling us here for Aussie Kiwi. It's getting a very bullish reading. Awesome. Let's go to the chart. Let's see what it looks like. Okay, so you have, this is old. Let me remove this alert. You have support here, right? You also have the 200-day moving average within this level of support, right? So that's good. This is probably the bottom end of the range. You also have the top end of the range right here, and you are right in the middle of that range. Now it's bullish, but again, when you are buying in the middle of the range, that is usually not a very fun place, not an attractive place to buy, right? Your cost basis is keeping you vulnerable here. So I would rather wait for a pullback of some sort, either a revisit of this level of support, or if you measure this move out here, and if you want to be slightly aggressive, then maybe the 38.250 or the 61.8 all pretty much lines up right here with this like level of structure. That's like an aggressive approach. One approach which I like to do is like if you want to be kind of in the market, order right here, very, very low size, and another open order right around here. That way, if you get tagged into both, your cost basis is likely still pretty decent, and you can still have a positive risk to reward right over there. That's like one way you can play it. So you can, that's kind of how I would do it. But not financial advice, of course, just my thoughts. I've been neglecting the miners for a long time here recently, so I wouldn't take this trade, but that's just kind of my way of approaching this market. But guys, I'm going to pass the show over to Nick and Marilee here. So I will be back here very, very shortly. Have a blessed rest of your morning, guys. See you soon. Bye-bye.
Don't go anywhere, traders. The show will be right back with our next show host. But before we get back to the show, I wanted to mention today's live stream sponsor, Ola Prime. Ola Prime is one of the fastest growing prop firms that I've seen in the space, and they offer a super wide range of different account types. Whether you trade Forex or futures, whether you're a swing trader or you're a day trader, they have multiple different account types, and they have some of the most competitive pricing that I've seen in the industry. And check out this publication from Deloitte, who did an audit during a select period of time on Ola Prime and its payout legitimacy. One of the big things that Ola Prime is well known for is their very fast payouts. They have this posted up all over their website as one of their main reasons that traders like them. From what we've seen, they also have a very strong reputation overall within the trading space, and they are a proud sponsor of our everyday trading stream here. And for a limited time, if you use our promo code that you can see on the screen right now, A1 Trading, you can get 20% off any of their accounts. And using our discount code lowers the barrier to entry, meaning that your challenge costs you less and gets you that much closer to potentially getting a payout someday. Of course, to throw my 2 cents in there, I'm a big fan of not trying to get funded until you feel you are actually ready to do so. So if you feel you have the skills, if you feel that your trading is up to par, and you do your due diligence on Ola Prime to see if it's right for you, then make sure use our promo code to get that extra discount at checkout, and we'll be dropping the link to them down below in the live stream chat. You can also find it in the description, and we'll have a QR code on the screen right now that you can scan if that's easier for you as well. So thank you to Ola Prime for sponsoring today's live stream. Now back to the next show. All right, guys, welcome back. Thank you for being here, and shout out Alan for the great segment that was just on there. I enjoyed listening to his commentary, and we are now back on with Marilee. Hi, Marilee, how are you?
Hello, how are you?
Good to be back for another macro conversation here, and we've got a lot to talk about today because there are some interesting moves taking place. Since we've last spoken, yields have continued to move higher. Precious metals are lower today. You have stocks lower today, especially tech stocks down. Where are you watching most in this market? Precious metals, very interesting this morning. Gold down almost 2%. Gold or silver down 2.5%. And maybe the catalyst here is what looks to be a little bit of a breakout in oil prices. What are you watching today?
I'm mostly watching the long end. It's been interesting over the past couple of days, especially with last week. We had the NVIDIA earnings, which obviously were like killer earnings. And that kind of helped solidify a little bit of like the demand concern of like, is all this CapEx getting monetized? And 75% margins are solid. So like they crushed it. And then right after that, we had the Jackson Hole, which was, definitely a little bit more hawkish than I kind of was expecting. And it was a brief little, it was interesting because like the 2-year, obviously in response to Warsh being a little more hawkish, went up. And then largely the long end was pretty flat, right? And then now we're seeing, yesterday, even the 2-year was kind of slightly down while we saw the long end up. So it's like, it's almost like the market doesn't quite believe that the Fed will do anything. What do you think?
Yeah, it felt like that for sure because the 2-year yield really reacted. And I think that my thought process on it is I think that there is the possibility that they hike. I'm still tentatively holding on to the camp of thinking that they won't hike, but the challenge is the 2-year yield moving higher like this. What I think that suggests is that they might hike, but it might be sort of a reluctant one. Like they'll hike and kind of signal, we don't really want to hike more than this, but we'll do one just to sort of a risk management on inflation type hike. The trickiness here, though, is that now the 10 and 30-year yield is starting to move higher. I think that this is more structurally based on oil prices and continued sticky inflation. Because obviously, like when you're looking at the long end of the bond market curve, for newer traders in the audience, this is, if you lend the government money for 30 years or for 10 years, right? This is the payment rate that they'll give you, the interest per year that you'll receive for lending money to the government in the form of a bond. And that number just keeps rising. And it's been a fascinating story. This, the Treasury wants to keep the long end lower because this is, obviously a weight in terms of government debt spending, et cetera. And then simultaneously, you have, as you pointed out, the Federal Reserve, Kevin Warsh, coming out hawkish, sounding like that they might need to raise interest rates. And it's really interesting because you have kind of a tale of two, wings of government. Although the Fed is not government per se, it still kind of plays the role of being in charge of money to a certain extent. So it's interesting. You have the president and Scott Bessent, Treasury Secretary, wanting to keep the long end lower, while simultaneously you have the Federal Reserve hinting at needing to hike rates. So it's like two forces playing against one another. And at least right now, the market doesn't seem to love it. I had a long position that went against me on gold. I went long gold, completely flopped here, and gold is moving lower off of this higher oil prices, higher yields this morning. I'm not too pressed about it because I think it's giving me a better chance to enter at a better price. I do like the 50% retracement and even the 61.8% retracement here on gold. I still really like gold. I think in the end here, I think that there's a lot of incentives to find ways to keep yields lower, especially going into midterm elections, et cetera. And if that is in any way successful, then I think gold could continue to see a overall upward trend. That being said, price action has been certainly challenged in the last few days. What are you watching, Marilee? Are you watching precious metals? Do you trade them ever, or do you mostly stick to individual equities?
So I've actually been adding to GDX shares. So
Okay.
I added a little bit on Friday. I've added quite a few. Let's see, it was down in this range. I initially started adding a little bit back here. I think it was around March, but I added quite a few here, and then I added a little bit on Friday when we closed. This is really what I'm watching for to add more. So we're actually kind of going into that range of like 44. I don't know if we'll get down to 42.
Sure.
If we do, sweet, that'd be great. Because I agree. I think over the long term, and this is like something that I always try to emphasize when I talk to especially new traders, is like you have to be able to match your time frame with the trade that you're taking and like the thesis for the trade, right? So like if we're saying, I think gold is gonna, pull back a little bit more, but my thesis is that it's gonna go up from here. That's not like a month trade. Like that's not a short trade for me, right? And so it's really important to be clear on like how long do you think this trade will play out and match your time frame to it, right? Because it's super easy to just be like, oh, I think gold's going to go up from here. Nick thinks gold will go up from here, so I'm going to enter a 1 month trade and I'm going to keep my stop super tight. It's like that doesn't match. You know what I mean? So it's very easy to get stopped out that way.
Yeah, I think that's a really good point because again, the time frame, the idea, and if you're an options trader, which you are, right? Like you've got experience in options, how important that variable is. That what time frame are we talking here? Are we talking something where we're looking at trading weeklies? Are we trading 0 DTs? Are we trading 45 days? There's lots of different literally options for different ideas. So I think it's definitely a good point. And most of the time when I'm talking trade ideas, for me, it's the next few weeks, like ideally. Like a good trade for me, because I trail stops, lasts weeks to maybe months if I'm really on it, if I catch a really good trade. From a position trade, I do some position trading as well. That could be months to even quarters, which would be awesome. Typically for me, it's like if the longer I'm staying in a trade, usually it's because it's working. And if it's a really quick trade, it's usually because it's not working and I just cut the trade really quick. So we'll see. But I generally think for gold, I am here in the short term. Gold clearly seems to be pressing lower and maybe trying to test some more levels. I wouldn't be shocked if we did see, like I said, gold come down, maybe test this 61.8% or even the 4,200 level. I do think personally, to add some quantifiers, I do think gold has potential to bounce here around this 50% retracement. So when I say, I'm thinking that it has upside, I'm kind of thinking, I like to call them campaigns, where I will take more than one attempt here to potentially get long gold. So maybe I'm mapping out a trade where here's my first attempt. If this just completely flops, actually, let me be fair. This is not my first attempt. I tried to get long. It did not work out. Price flooded lower. I'm glad that I stopped out when I did, because it's continued to move lower. This might be a setup for me. If this fails, it is what it is. Small loss. I can reset. Take a look here. Maybe there's another setup for me there. If so, maybe I can catch the right one there. And if I don't, if it just floods through all of them, my trade size is going to be small enough that it's not going to devastate my portfolio. And I think that's the really important, factor here. So we'll see how it all plays out with we have a lot of economic data this week. The non-farm payroll number on Friday is, of course, a really big one to see what the jobs market has in store for us. If jobs come in solid, what do you think, Marilee? If the jobs market comes in on Friday really solid, do you think that sets up the Fed to hike rates, or do you still think maybe they'll continue to wait?
My base case is that the Fed hikes at least once. That's
okay.
Just kind of, with everything going on, I'm thinking at least once. I'm personally putting less emphasis on the non-farm payrolls, just because Warsh made it very clear that he's not super concerned about that. So while I think it is obviously going to be marginally impactful, we've had kind of, I wouldn't say like shaky labor market, but we haven't had a super strong labor market, right? So if we get a super strong labor market and we're already leaning towards inflation is their main goal, we're at 3.7% PCE and they want to be at 2, like that's kind of far away. Like I think we're already leaning that way. So I think if we do get a strong non-farm payroll number, I think that will just increase the chances of a September hike. I think we're at like 65% right now. We might go up to like 70, 75. And obviously that can change because, we still have data coming out through that. I didn't check the ISM services or the any of the data earlier, but one thing I did want to mention about, you were talking about gold, is this is one of the dashboard that I make, but as far as the correlations between the two, the relationship between the dollar and the gold is pretty solidly negative. So one thing I'm watching in regards to gold before I start adding more aggressively is how is it looking relative to the dollar, right? Is the dollar starting to roll over? And if so, like that to me, because we've had this negative correlation with gold and the dollar, if the dollar starts to roll back over and starts to weaken, that to me is like, all right, well, maybe, depending on where we are level wise, depending on if we've had some sort of like, maybe consolidation for a day or two or something like that, where we potentially have a support to move up off of, that might be, a little bit more of a strengthening, like, all right, I think I'm going to get back into gold or add a little bit more to gold here.
Sure. Yeah, no, that makes sense. And I think, recently when we look at the dollar has been on a bit of a rise here, obviously putting a little bit more pressure on those precious metals. Coming into some levels, I'm curious from a technical basis if we can see some kind of hold from bears here around the 38.2 to 50% retracement. Simultaneously, you have kind of an interesting dynamic playing out in the stock market. It's been really impressive, I have to say, in terms of the stock market's ability to hold up fairly well, given everything that's been thrown at it. You've got re-escalation in the Middle East. Simultaneously, you have yields blowing out higher. And you also have a Fed that has pretty much signaled that their next move is not going to be a rate cut, that it's almost certainly right now, the base case is a hike is more likely than a cut. Of course, we'll see if the cut, or I'm sorry, if the hike is a one and done, if it's a 0, or if it's a 2 times. Obviously, these things are changing constantly. And if you do get a hike, there's kind of an interesting scenario too here, which is if you do get the hike, and it maybe 2 or 3 hikes is in the works. Like if that starts to take place, then gold probably is way back down here in the lows. Whereas if you get 1 hike, I think gold is kind of being priced for that now. You could see maybe a little bit more downside. And then if you get 0 hikes, I think that's the scenario where gold really likes that. So it's kind of an ongoing story, and maybe the easiest chart to watch for this, at least in the short term, the most volatile component of all of this is what happens with oil prices. And oil prices, at least for the last few months, have been chattering lower with volatility, but for generally putting in these lower highs. And now we've got a little bit of a threat to that story with oil prices here trading at the highest level in the last month or so and threatening maybe a bigger move. And then the other side is if you take a look at like energy stocks, XLE is doing fantastic. Like this is the best performing sector of the year right now, and just keeps winning. It's fascinating how, this sector was like left for dead the last few years, and then all of a sudden now it is the cream of the crop in terms of stock sectors. Are you doing anything? I know we previously spoke about energy stocks a little bit. Are you doing anything with them?
Not currently. I did ride up the initial first leg up with energy earlier in the year. And then I had a couple different options and closed out pretty nice profit on that, but I haven't re-entered.
Gotcha.
Just honestly, my base case was that this Iran war wouldn't last as long. That was my thought. And then, yes, was it Sunday? And I think Sunday when the US and Iran kind of exchanged strikes for the first time, and I think it was over a month. I think that's largely, what pushed up the long end relative to the short end after Jackson Hole, because there's that, re-escalation. It's higher oil prices, if it's short enough, it's, what is it? Transitory is the word they use. But the longer it lasts, which is obviously now we're going on like months and months of this now. And it's not like, obviously it's not back up at 120 or like all-time highs, but it's still like definitely elevated. And that feeds into, the supply chain and the cost of transportation, which costs of, producers and all these things. So it's like, it eventually feeds down into the CPI, which is, obviously why we're seeing the inflation risks that we're seeing right now. But I agree that I think, oil going back into the 90s is probably going to keep putting pressure on the long end, on tech, on long duration. Like that's, it's just, that's the trend we're seeing. And I don't, unless Iran gets resolved, I don't see that changing materially. At least not for a while.
It is hard because you think about it, even if they were saying this within like the first month of the war, like even if the war ends, there is still structural inflation that's kind of like embedded in this process, because now you have all of the, the one that I kept seeing around was that just physically moving the ships through the Strait of Hormuz and dispersing that oil would take months because they're so slow moving. And so now at this point, you have traffic still at a bare minimum going through the Strait of Hormuz. And here we are, like, I don't even know, 6 months later, we are still nowhere, at least on the surface, nowhere near at an end of this war. And now we've also seen kind of the White House go the route of saying economic warfare as opposed to military. And it seems like some people took that, or at least the market kind of took that as a bit of de-escalation initially here. But I think that the reality remains, which is ships are not moving through the Strait of Hormuz. It's a huge amount of the global oil traffic and supply. And so that's kind of just keeping these oil prices, even if oil does not fly up to $120 a barrel, even if it just stays here for a long enough period of time, that is, as you pointed out, structurally just going to keep a bid on inflation for the long end of the curve for some time. And these things take a long time to kind of, these supply issues take, like COVID took forever to like work through all the supply constraints that were caused because of the, global economy shutting down for however long it was.
Yeah. Well, and then the difference here is that in COVID, they were injecting a ton of liquidity into the markets. They're not doing that. I mean, they're doing it in the form of CapEx. You know what I mean? There's infrastructure build out, but it's not the same type of liquidity as it was in COVID. Like they're not trying to stimulate the economy. The economy growth is strong, right? And so that's kind of like a big difference between the two times. But the longer that there is that pressure with oil prices, longer there is pressure on the long end, like the more attractive, honestly, a Nasdaq or QQQ, put spread is to me, to be completely honest. I mean, the chart itself, like we're still sitting relatively close to highs. We could definitely have a 5 to 10% pullback off of, from current area, and that's, even then we're still in an uptrend, I mean, we're still in a bull market at that point. Like we're not necessarily breaking market structure of recent lows or anything. And we could just, I mean, that would just kind of be that even the seasonality now is like, that's kind of what the seasonality this time of year does anyways, is a little bit of a pullback. And you're just layering on top these different factors that are all kind of pointing in the same direction, at least temporarily, unless something crazy happens and, say Iran gets resolved, or, I saw something with the Venezuelan oil. I didn't see a bunch of details, but, potentially easing up US oil prices in that way. But obviously there's nothing concrete. And I think the timeline of that is much longer than what, the headlines suggest.
Yeah, and you mentioned the seasonality of it a little bit here. I just wanted to pull up some charts to give a visual to the audience. So this time of year, going into September and October, at least for the stock market, there is an observable, meaningful statistical probability of a weaker period in the stock market. So to kind of lace that into what you're saying about maybe a little bit of a pullback or correction, I actually pulled up the VIX seasonality here specifically because September and October are historically, in the last 10 years at least, a pretty meaningfully more volatile period going into this time. At the same time, we also have, as we were just talking about here, if we take a look at the S&P 500, September is a negative month in the last 10 years. And I believe over a longer stretch, maybe even like 40 or 50 years, September is just an interesting kind of return to the desk for a lot of hedge fund managers, and big money kind of comes back from their summer vacations. And maybe for whatever reason, they just decide to kind of de-risk their portfolios a little bit. And there's also some meaningful seasonality as well in midterm election years, where you have a lot of uncertainty around political changes, how it could impact things. And this year especially, there's one kind of up for debate, hot topic, which is all the data center stuff, right? Which has recently caused a little bit of a hiccup in the AI trade, little concerns, or at least, some people would argue that it has. I don't know how meaningful all the debate around data centers in people's backyards are moving the stocks lower, but at least right now, I would argue probably the treasury or the yields moving higher are probably putting more pressure. But also there is political headwind, midterm elections ahead. You have seasonal volatility. There's enough reasons here, I think, that you are getting a little bit of de-risking in the stock market. And you have to remember, I mean, we are still well off the highs on Nasdaq, S&P 500. Not significantly off the highs. And maybe to your point there, maybe there is just a little bit more room here for healthy, normal corrections, pullbacks in the market that move all the way down here to this 73.40 level or so. That's just a 6% move from the highs. So it's still very within the realm of normalcy for a bull market. And it'll be interesting to see if it happens.
Yeah, for sure. Yeah, I mean, like that would be the S&P going down, what, like 6% or something?
Yeah.
S&P goes down 2%, 1.5%, and people are starting to lose their minds. It's like we've gotten normalized to this up only, over the past, really since 2022, we've been, with the exception of, the tariffs and things like that, we've been in a bull market, since 2022. So it's like we're pretty conditioned now to this like easy money market environment. And like, we are just not in that anymore. It's not to say you can't make money, but you have to be way more selective about your, which trades you do take, because not everything is pointing, green light, green light, green light, right? There's a lot of things that are coming into play that are starting to push, a little bit of yellow light flashing, a little bit of red light flashing here and there. It's like, you just need to be more tactical.
I think it's a good way of putting it. And it's hard. It is very difficult to try and be like, a bear in a bull market is just a really tough trade to play. And I think, to your point though, we have had a pretty good stretch here since 2022, where the markets have had really outsized great returns and a mostly low interest rate environment going into this. We've gotten used to, as you pointed out, For some time, the market only goes up. And at this point, we now have the 10-year yield pressing back towards the high end of the last, 10, 15, 20 years. If you take a look at the 30-year yield, it's even higher. We're at the highest point since whatever this is, 2007. So you have yields kind of writing up an invoice, if you will, for the market. Because this is, I listened to somebody talk about higher yields. They put pressure on valuations like PE ratios. Investors are less willing to pay high PE ratios in a higher borrowing cost environment. But then I also saw somebody do a little bit of a breakdown correlation wise on profit margins for companies. And I thought that was really interesting. So there is a inverse correlation with profit margins and interest rates or yields. So for example, most people are macro people are understanding that, okay, higher yields, it's a higher borrowing cost, puts pressure on investors, capital kind of tightens up a little bit, and people are willing to pay less in terms of a price to earnings ratio for stocks that they like. Simultaneously, margins over a long stretch of time, they have some sort of an inverse relationship with 30-year yields or 10-year yields, et cetera. Higher yields cause profit margins to contract. And it only makes sense. If you think about this from a company going out and borrowing money, which gives them leverage, gives them the chance to rapidly expand their business or grow, their profit margins are easier to expand if borrowing costs are low. If borrowing costs are very high, businesses are less likely to lever up like that. And so we've seen this environment where profit margins have been endlessly expanding for the S&P 500 for a very long time. And now you have maybe one of the drivers of that revolting, moving the other direction. So I wonder if that will put pressure. And to your point, I'm not a bear on this. Like market, I don't personally, I'm not calling for a ginormous stock market correction, but I do think picking your spots is increasingly becoming important. I still want to be with businesses that have profit growth, even if interest rates are not, as opportunistic as they previously were. I hope that makes sense. Sorry, I ranted on that, but I thought it was an interesting video I saw.
Yeah, no, it makes sense. It's like if you think about it, and like just a normal person, it's like if your income every month is however many, like say like $5,000, and then your car payment is $1,000, then all of a sudden your car payment jumps up to $2,000. It's like your available cash to do anything with is now shrinking, right?
Yes.
So it's just the same concept. So it's like, and that's why, like, specifically, and it's this weird kind of tension, because the companies who tend to do well the most in these type of high interest rate environments are the ones that have really solid balance sheets. They have strong cash flow. They have, low debt, things like that. Those are the same companies that are now at this point spending a lot of that free cash flow on CapEx, and they're maybe starting to take out debt to fund this, CapEx and spending. And so now these higher interest rates, which normally don't affect them very much, are starting to pressure them. And those are the ones that are essentially carrying a lot of the index, right? So it's like, that's where it's like, it's getting a little dicey. Like, I agree with you. I'm not a bear. I think we still have more room to the upside before we actually shift into a bear market. So I don't think we're there yet, but it's, like I said, it's like that, getting to that, almost like that, the point in the cycle where things are starting to, like, it looks like a lower high, but is it going to break to new highs? Like, are we shifting? We're not there yet, but it's getting to that point. And that's where it's like, it's even more important to just be aware of, like, what are the signals that we're watching? Credit for me is a big one.
I think that's a really, really good talking point. I think I would say personally that I generally like companies that have, and I know this sounds obvious on the surface, but free cash flow heavy companies, stocks that have, maybe dividend payers even, that's kind of boring, but dividend payers, stuff that has cash on hand, that have free cash flow, that have solid, consistent revenue and earnings growth. That may sound obvious, but you have to remember a lot of the stuff that is high flying and doing fantastic is not that, right? A lot of the stuff has been the stuff that is highly levered, dramatic profit growth and revenue growth, but you could potentially point to, well, you've had a pretty hospitable environment for some time. And then, maybe that's another reason why the Magnificent Seven have been kind of a not great spot the last like year and a half. They are the ones spending a ton of money here in this environment. And I'll throw out an idea that I like. I still really like software companies for this reason. A lot of software companies are very, very cash liquid businesses that are not necessarily so leveraged and spending all their money on AI stuff. So I like software businesses because of they make a ton of money effect, and they are not necessarily the CapEx spenders like the Magnificent Seven and or a bunch of the stuff that is tied to AI. So just a thought.
Yeah, I actually entered IGV a
Did you?
couple calls on Friday. Yeah.
Very nice.
So it's still sitting kind of around there, but same thesis. I agree. I think that software is due to outperform and be the receivers and monetizers of the spend that is being, spent, I guess, in this CapEx and things like that. I think IGV and just software in general will be a solid trade.
Yeah, I love it. And Marilyn, thank you as always. I want to shout out you for coming on here again. If you guys enjoyed her commentary, we're going to drop the link here. There it is already. Beat me to it. The producer got me on that. Follow Marilyn on Instagram. If you want to check her out, find her content there. I highly recommend that you do so. She knows her macro. It's awesome to bring her on here once a week and just get her thoughts on what is going on. Marilyn, thank you very much for coming on the show today.
Appreciate it. See you guys.
See ya. Guys, up next, he's back for round two. We have Alan Perez coming back on the show here. Markets are continuously seeing some volatility. You look at this. You got stocks. You got gold. Gosh, like it's the JOMO feeling now. I went from, gosh dang it, I got stopped out of my gold longs to, oh gosh dang it, I got stopped out of my gold longs before they kept going lower. Will I try again? That's the question. Am I ready to get whack-a-mole again? That's another question. Anyways, with that said, up next, we have Alan Perez coming in just after this quick break to take a look at more markets. Stay tuned. If you're enjoying the stream right now and would like to join us beyond just live streams, consider joining our free-to-join Telegram channel. Inside of our Telegram channel, we're sharing daily market analysis, bonus clips from the live streams and videos, giveaways to our products, prop firms, and brokerages, and much, much more. So like I said, if you're looking to stay up to date with ideas that we're looking at in markets, even if you can't make it to a live stream, consider joining our Telegram channel down below in the description of this live stream or being dropped in the live stream chat as we speak. Just click that link, it'll navigate you over to Telegram, click join, and you can come back to the stream. It's totally free to join, and if it's easier for you, you can also just use the QR code that you see on the screen right now. Now back to the live stream.
Good morning, my friends. How you guys doing? Good to be back here for round two. Yeah, like Nick said here, JOMO, right? Let this thing do its thing. Glad I wasn't entered right here or anything like that. Very, very interesting to see how far this really goes and does it get disrupted. One thing I saw here, which was different, market is now pricing in a 2 rate hikes rather than 1 and done, which is interesting there. Now this does fluctuate all the time, right? So keep that in mind, like the chat said, but definitely not something to ignore. You have, again, like I mentioned earlier, you have yields kind of stretching higher there, which is not going to be good for the rate cut story, right? For anyone that's out there, like myself included, that's thinking like one or like no rate hike, just neutral the whole way until you start rate cutting. That way of thinking, right? My kind of idea there is starting to get disrupted. There's definitely now a case for 1 rate hike, 1 insurance hike, and then go from there. So, excuse me, I'm watching that here closely. I personally think that the market has already priced in successfully 1 rate hike already before. So it's just anything beyond that is what I have to be mindful of and what I'm looking for. But for now, you're seeing, man, look at silver down almost 3% today. The metals are getting crushed today for sure. Gold here down 2.4. Any short sellers out there, congratulations out there. And yep, got the black liquid now with me here. Who remembers Nick's monster gold trade? Yeah, man, that was a great one. Can't believe Nick isn't jumping back into the trade. Well, the macro is just telling you to kind of hold off a little bit. You got oil higher, you got yields higher. I mean, oil. Look at oil is just continuing to stretch higher there. Right? That could definitely disrupt your reasoning. Right? You go from like a super strong setup to like strong setup to okay setup. Right? Like that's kind of how I see it. So yeah, you have yield higher as well. Yeah, it's a bloodbath out there, it seems like, for the metals. Lots of volatility. Bitcoin is starting to react, not really much, but I'm still watching it. Looking to trade this potentially. I like the idea. Starting to kind of stall out here at the top end. Where's my Epic pen? There it is. Starting to stall out here. We had a really crazy monster run up here. I like this. Hopefully we get some kind of a break below. Let's see. Anything? Did services come out already? I believe they did. Maybe. No, it comes out later today. Okay. Well, Marco's going to join me here very shortly, and then we'll go over that news release together. Bitcoin rating on Edge Finder? Sure. Let me go ahead and pull that up for you. Let's go to crypto only. And Bitcoin is neutral right now, getting close to bearish. If this thing does flip bearish, I would actually be very interested. I like the risk to reward on this setup. So like even if you were a bull, right? Like you're hitting this level of resistance right here. 1, 2, right? Potentially 3. If you're bullish, then you're probably looking for a pullback into this level here. I'm kind of bearish on this, right? I think that you kind of see Bitcoin, not that it just falls off a cliff here, but I do think that likely than not, like a lot of asset classes this year have been just kind of range bound, right? Just range bound grinding. I like that. So for me, I'm like, okay, if I want to catch the range or participate in the range, I could enter here, stop loss above here structure, and then I can target the 61.8 or even below that at 62,000, right? That's kind of what I'm looking for. I like that. If yields continue to go higher, that definitely hurts Bitcoin, I think, personally. Also to just waiting for the edge finder to give me that green light, that bearish reading, and then I likely take the trade. PMI or NFP could move this thing back up for sure. Yeah. Harris says, feel bad for anyone who bought. As long as it's risk defined, man. If it's risk defined, you accept the loss before you enter the trade, then you should be fine. That's where a lot of the problems and the unnecessary stress comes from, when you like get into the trade, but then you didn't really think it through, or maybe you just got excited, or maybe you were just fixated on the potential reward and not the potential risk, right? A lot of us can get into a trade very easily when you fixate yourself on the potential reward outcome. You're like, oh man, I could make X% return on this thing, right? But then you ignore the when you're wrong, and then that's when you start to make rash decisions on the fly. It's never good. Well, what if you don't like to lose? Well, then you should probably pick up something different, man. You should probably find a new career and just want to win all the time. Yeah. What's an industry where you can just win all the time and never lose? Because even in options, right? Even when you're selling premium, you still have, it's high probabilities, but you still have a loser. And when you do have that loser, you got to be able to absorb it. Ooh, one opportunity hit the nail right there on the head. Court seller. That is actually you actually found an answer that you found an answer that I didn't think about. That is true. Court sellers, they always win. They never lose. If you go to their pages, only winners, only trades that win. You got me there. You got me there one opportunity. I didn't think there was an answer for that, but you got me. Harris says, I love losing. Yeah, core selling. Ramirez says something else. Ramirez, I would argue that you lose quite a lot in that endeavor too. So I think core seller is a pretty safe option. One opportunity, shout out for you, man. You came up with the answer. It's a pretty good answer too. trading will kill the ego of a perfectionist. Absolutely. Absolutely. And it's like even if you do everything right, everything you could have, there's always like, dang, I could have done better, or um I could have handled it better. Like you're kind of never satisfied when you're trading. I think Chris Pulver said this, but like you can have, I don't like, you could short, I don't know, you could buy gold from here and take profit here, but then you miss like this piece of the pie. You're like, oh, right. Like you're never satisfied. Ball says pickleball instructor. I might do that, man. One day. No employees, no. Oh, I don't know about no rent, man. I don't know if that even is a thing. How could you have no rent if you're a pickleball instructor? Unless you live at the country club. Then maybe. I see what you mean. Ball says just a paddle and an eager, rich person wanting to learn. Guys, I think I have the sniffles. Let's see. Just continuing what we're seeing here in the markets. So, risk off day, I would say. You have equities with the Nasdaq and S&P down. You have the VIX higher. You have the dollar up. Definitely risk off. Metals here bleeding today. It's definitely a risk off day. Let's see. Let's look at Aussie dollar. If it's giving me any pullback opportunities, and it's not. So you have kind of this right here. You either have a 38.2. You either wait for one of these to happen. I still like Aussie. It's pretty good. Pretty strong currency. A pullback into one of these levels or a break and retest. But it's been kind of just slowly grinding higher, which is good. But the thing is, it doesn't give you any opportunities for pullback, or entries. So I kind of have to just watch this thing do its thing. And I think it's the only one left on the majors that is still bullish, if I'm not mistaken. Yeah, Aussie dollar is still the only one that's bullish. Now you have pound, euro, kiwi, all neutral there, which not the best reading. Do I buy T-bills, T-bonds, part of your portfolio? No, I don't. I really don't. Just because you have to tie up your money for a little bit, depending on the duration, whether it be a 2-year bill or a note. And usually, like, if you're trying to maximize, if you want a essentially a risk-free investment with an attractive yield, then it makes sense. But then your trade-off is less liquidity, because you have to keep it till maturity unless you break it, and then you have to pay a penalty. The other way would be about like a high yield savings account, which is one thing I like to use. But then you're kind of subject to what yields are at the moment, right? So like if you have yield as a collective kind of trending lower, then that's going to be reflecting on your high yield savings account. If you locked in a T-bill or a T-note, then it's just locked in, right? It is what it is. I prefer giving up potential yield for more liquidity. It's also just super easy, man. It's just like a savings account, really. It's all it is. It's a savings account with higher yield potential. And right now, it's doing well. But if you were to have rates like, near 2% or whatever, then it won't be as good, right? It'd be very low. And the rates that they give you for like CDs, high yield savings accounts, is always lower than what the Fed funds rate is, right? And there has to be some kind of a markup there for the bank to make money. So I personally don't buy T-bills or bonds. It's just I would rather have the liquidity rather than kind of tying it up. Now, there's one thing you could also do is you can ladder them, which we did at the bank. It was very popular when you had rates kind of coming down here or projected to come down, and you knew that CDs and high yield savings were going to come down with it, but they wanted that risk-free investment, and capturing that high yield is where you can ladder them. So you have, one expiring, or let's say you have one maturing 6 months, and then another one a year from then, and then 6 months from then, and 6 months, 6 months. So then, like every 6 months, your bills are kind of coming due here. You get your money back, and then you can have some sort of liquidity. And then if yields are still high at that moment, well, you can keep rolling it in, right? So that's kind of what you could do as well. But again, that's kind of out of my wheelhouse. I don't need to do all that. But yeah. Hey Marco, my bad man. I didn't see you jump in here. How you doing?
Yo, I'm pretty good. What about you?
Very good, man. Bloodbath that we're seeing there in metals, huh?
Yep. It's pretty rough. Pretty unexpected from me personally. That was the exact opposite of what I was betting for and am positioned for. But I guess it's the reaction for the US yields that are starting to climb up. So let me just share my screen here. Let's go to share. Okay. So if I look at the 30-year, it's starting to climb up higher. The 10-year is really starting to trend up and kind of approaching, I would say, a key level where the 10-year has been stuck in this range for a while now. So ever since, let's say, October 23, if we break this high, that's going to be, if we break 5% in the 10-year yield, I think that's going to be very, very important for the market and could be some sort of a turning point or just could cause a lot of volatility.
I think the exact same. So a 5% 10-year yield starts to kind of raise some eyebrows. You start to question, like, okay, are we going to have to go into a rate hike cycle? Like, is the market thinking that inflation is not going to be a one and done kind of pass through thing? And if they think it's going to be, definitely what I would expect the market to kind of take a 5% 10-year yield as. But we'll see, man. CME Fed Watch tool, which changes all the time, is now pricing in a 2 rate hikes. So one in September. We'll go to probabilities here. One in September and another one in December of 2027. So, or sorry, not December 2027, January 2027. So you have 2 rate hikes now kind of up in the air there.
Are they pricing in a hike for September?
Yeah, a hike for September here, a 66% chance. And then you also have one more in January at a 39% chance.
Because if you look at the current, if you go to the Fed Watch tool, if you go to the upper left and you click on current and you go to okay. So there's been a big repricing here. This was like 50-50 at one point, and at one point even like 70% chance for a hold. Okay, that is very, very interesting actually. And in my opinion, still a pretty good opportunity. Yeah, sorry.
No, yeah, I was gonna say, I think like you said, you touched on this, like the direct input is going to be oil and yields, really. That's really pushing this higher. But you were gonna say something?
I was gonna say it could be a very good opportunity if the Fed doesn't hike. So if they keep the rate the same, so if on Forex Factory you see the forecast being a hike and they don't hike, well then that would be a big repricing and a big opportunity to go in the opposite direction. But what do you think? What is the key print until the Fed? Is it NFP? Is it PPI or is it CPI?
I think it's really like going to be NFP. So like my whole reasoning for thinking that the Fed's going to be neutral is because you've had, a kind of round of cooler inflation prints, but then you've also had labor market data that has been weakening, right? And so my thought process was, well, like if you have inflation taking care of itself, and also too along that time, you've had oil prices lower, like all of June, you had lower prices lower, you've had lower oil prices relatively kind of under this bearish trend line. That's a good sign. So it's like, okay, well, if inflation is taking care of itself, then the market or the Fed can go ahead and target the weakening labor market because they have that dual mandate, right? So if one side of the mandate is taking care of itself, they can target the weakening labor market. That's kind of my thought process and framework. But now you're having oil higher, yields higher, which questions the entire inflation aspect of it, right? So if inflation does start to run hot again, well, then maybe the Fed has to now go from just targeting labor market to asking the question, do we target labor or inflation if it starts to run hot again? And then you have NFP Friday. So if NFP comes out very strongly, well, then maybe they can shift their focus entirely from labor to inflation, because assuming that you have oil prices still elevated and yields elevated, right? If you have a strong NFP report, well, then that just gives them all the justification for them to probably do a one rate hike type of thing. So as the day progresses and you continue to see yields get bid up, and oil higher, I do think that there's a probability that the Fed actually does start to hike at least one time. Now, I think even 2 rate hikes were already priced in before, right around here. So I think the market's really kind of signaling, like, is it going to be a one and done insurance hike, or do they start to get concerned over the possibility of what inflation could do, and they go from a neutral to a rate hike cycle? So I think that's what's really going to determine whether you see, for example, out of the ordinary strength in the dollar, right? If it's a one and done type of hike, I feel like that was already priced in already. You can kind of continue lower. But if it's not, then you probably see dollar revisit like something like 102 or 105 or 100.5. Definitely.
I'm sorry, you're cutting out a little bit. I don't know if it's my connection or what. Just give me 1 second.
Yeah. What part did you hear, the recent chat?
Most of it cut out in the last like 20 seconds. Okay, I can see the screen now. Your camera is moving. Okay, cool.
Is it moving?
But I got the gist.
Okay.
Can you hear me well?
Yes, I can hear you well.
Okay, cool. So what I wanted to say, it will be pretty weird if we get a weak NFP that they hike going into that. So I think if we get like another negative NFP or break-even NFP, like near zero, let's say, I think just hikes are off the table. And then as far as the inflation goes, let's say we get an NFP as the forecast, like 50K, and then inflation comes in the same as before, like 3.4%. I think they jump on that and say like inflation is overall starting to cool. Current rate is already restrictive. We're in the wait and see mode. Just similar to the last Fed meeting where Warsh was more dovish than expected, actually. And we get the forward projections, which should tell us what are they thinking for the future. So are they thinking a hike or a cut? Or another possibility is we get a hawkish hold. So essentially they hold rates, but Warsh comes on the press conference and says inflation is elevated, we need to do this, we need to do that, we need to hike. That's what Powell used to do. So he used to do either a hawkish cut or a dovish hike or a hawkish hold, dovish hold. So they used to combine a move with the opposite press conference to try and dampen the impact on the market, especially if it's something that the market won't like. And in this case, I think the market definitely won't like them holding rates the same.
Yeah, there's definitely lots of things. The only thing is, like, I'm very kind of watching this chart here, the third, like all of the yield charts here. You're starting to see some wicks here at the top. So well, not the 2-year yield, but yeah, I think that would be kind of like a really good scenario too, where you still have a scenario where the dollar
excuse me for 1 minute.
Yeah, sure. What I was going to say, guys, is that if you do have that kind of scenario where you have a rate hike, but then they come out and say, like on a press conference, like, yes, we're looking to hold from here. Like this was just a one and done type of thing. If the data shows and allows, we'll go ahead and start cutting. I think that will still be very well received by the markets.
Okay, I'm back. Just had to open the door for my brother. He doesn't have the key. Anyway, yeah. So what did you mention here at the last part?
I'm laughing at the chat here. Ball out is trolling as usual. He said the pizza is here. But no, man, I was kind of just going off of what you said. Like, I think that would be well received from the market. You know, if you have one rate hike, but then on the press conference, they kind of swing the other direction and say, yeah, we're looking to actively cut from here. I think that would be well received, man.
Yeah, it's interesting. I'm preparing for the event. I have an Aussie dollar long. I have a gold long. I want to take USD CAD short, so trying to let's say bulk up with the USD short positions. So far, it's not looking like the best option or the best trade, but we'll see. We'll see. I was also looking at the news. I didn't see much that would warrant bonds going up or the market going into risk off. So I'm not exactly sure why today we're getting that big drop on gold. Did I miss something? I know Iran is heating up a little bit, but that's about it.
I don't know, man. I saw something like the September volatility is coming back, right? Like people are coming back
Yep.
from vacations and all that. The volatility is running hot. Volatility was pretty low for a while, so I saw that, right? That was kind of like the justification for what you're seeing today, but headline related, kind of that's pointing at this, right? The only thing I can see and kind of point at it was like yesterday on Sunday, where you had the kind of escalations in the Middle East. But besides that, I didn't see anything about that today. So I think it's just kind of follow through from what we saw.
Yeah. That's what I'm thinking as well, actually. That's a good point. September volatility is coming back. Labor Day is coming up soon. Usually kind of the key date is Labor Day when the volatility really kicks back in. So I guess it's time to find some alpha in something that is not really connected with the US dollar. Because I'm watching stocks, I'm watching the SPY. SPY is supposed to open lower. Qs are not doing well. Yeah, SPX not doing well. So risk off week so far.
It's definitely risk off, Marco. And to kind of switch up the combo here, just to make it a little bit fun here for the stream, because we love to make it fun sometimes. Bolo asks a question out of curiosity: how many trading monitors does one need to be profitable? And I think everyone genuinely asks themselves that question when they get into trading. Like, all right, how many monitors am I going to get? Marco, do you have an answer for that?
How many monitors? I mean, if you don't have 5, you're not profitable. So 5 or above is probably a good answer. And then I saw a couple of traders have like portable monitors. So they bring a laptop and then you have 3 monitors that stick on the thing. So they have like a complete workstation while traveling. So people go crazy. But for real, you just need one screen. I mean, preferably a big screen, because you have to do some like back testing, forward testing on data or on charts. But one screen is more than enough.
Okay, how many are you running right now?
I have a wide screen, like a 34-inch. So it's like 2 smaller ones combined, and it's amazing, to be honest. I wouldn't change it for 2 screens.
Okay.
Like for charts and technical analysis, it's really, really good.
Cool. I run personally, I have 3 and then I have a laptop, but definitely overkill. Like definitely. Like if I'm being honest with myself, like one of these monitors here to my side is just like they're both portrait. So like one of them is just like the Discord chat, stuff like that. The other one is usually like media related or like financial juice, and then the chart is the main one here. But really, like I would say 2 max, like 2 solid monitors max, or 1 big jumbo one. But definitely overkill to have like, I don't know, 9 or 8 that you see out there. But again, depends on your trading style too. Like if you're like one of those like scalper guys and you gotta see like all the markets where that all at once, then I guess. But nah, man, I stick to like just 1 or 2.
Yeah, if you're scalping, if you're doing level 2, then it actually makes sense. So I remember from my internship at Positive Equity, which is a real prop firm, not like FTMO, but like they train traders in house and they give real capital to traders, and they trade a lot off of level 2. So level 2, if you guys don't know, is when you have all of the boxes and all of the prices, and you see exactly how many orders are at which price. So you having like a vertical monitor is great for that, because you can open like 10 different stocks, look at 10 different level 2 numbers, and they can actually spot a pattern when a big buyer or a seller is coming in, and they can get a better fill. So they don't really have a big edge from looking at the level 2, but they can tailor their entry and they can use a lot more limit orders rather than market. So they actually avoid all of the fees, or a lot of the fees. That's why they heavily focus on level 2. So like that's a bit crazy. When I was doing the internship and we had to study level 2, It's something that I really didn't like to do because it's so fast. It's like a computer game and like a roulette. You have like 10 roulette tables all spinning at the same time. So
And then Marco, what's your thoughts on like actively trading on like a phone or an iPad? Are you guilty of that, man? Have you ever like started going crazy on the phone or no?
I know there's a lot of traders on Instagram that use only a phone to trade. So I guess it's a strategy, but I wouldn't recommend it to anyone. You need to be serious. I think using the phone or an iPad just doesn't bring a lot of confidence in what you're doing. So
Yeah.
that's my take on it.
I usually just like monitor position or just like monitor the markets as a whole through the phone, like if I'm away. But like actively actively trading and like stuff like that on the phone, definitely not something that I do.
I use it with the laptop. So essentially, if I'm traveling, I have the levels put up on the laptop, and then I just copy everything in the phone MetaTrader app because like that's pretty good for just inputting a few numbers and a position, clicking buy or sell. I found that to be a great combination.
Yeah, for sure. Someone says Leon Davis says, what news source do you guys always use on a regular basis to monitor economics and news and trading? I love Financial Juice, man. It is free. It is near real time. They have paid plans too, but you only buy yourself like maybe a couple seconds of less delay. But financialjuice.com, super sick. It tells you everything that you need to know. If you go to market moving, it tells you everything that's like very impactful, like what's moving the market. So for example, Marco and I were telling the stream here that really what started this whole kind of shift in the market was on Sunday and Monday when you had the US Iran kind of tax escalate. So you can see here, right? This was that. And so you can see everything that's going on here in real time. So as it's developing here, you'll see it kind of pop up here in red. For example, if I keep scrolling, you can see Eurozone CPI here early in the morning for me at 4 a.m. And so on and so forth. So I like Financial Juice. I really love it. I really vouch for it too.
Yeah, like you can spend a lot of time watching junk online. If you don't have the right source for news, you can spend 2-3 hours just looking at complete crap. So I found the best combination is first Financial Juice. Once in the morning, go through the market moving and the Forex news. And second, on Twitter or X, I have a list compiled of all of the traders that I follow or the news sources. So instead of going to the For You page and looking at people getting killed in Ukraine or something like that, essentially I focus on just the thing that actually matters with traders, with the list, focus on that, and you're going to save a lot of time. You're going to actually get what you need because like social media can be the worst thing in the world for your brain if you go to the For You page, if I'm being honest.
Definitely. Like you get so many just like extremes, right? And then you don't even know if it's true or not. Usually everything on Financial Juice is like proven from what you're seeing is very clean, I would say. Marco, one thing before I go, I wanted to drop this golden nugget because this has made me so much profits, Marco. But like we talked about trading on monitors, trading on the phones. But one thing, if I can give a secret sauce before I pivot out here, is trading based off of astrology. Look at the stars at night and you get the best signals ever. Have you heard of that?
Yeah, I heard technical analysis is like astrology for men. I think that was the expression. So like women look at the signs, the birth signs. Men look at technical analysis. So that was the comparison.
There you go. All right. One thing I will say before I pivot out here, guys, if you guys are not in the Discord, VIP Discord, go ahead and consider joining. I just started doing my VIP trading signals again. So I did it very briefly. Then I started working with Oanda. And so from a regulatory standpoint, I was registered with the NFA. So that was a big no-no from a compliance standpoint. But I'm no longer doing that. So I'm able to go ahead and do the trade signals again. So if you guys want to join and just get one more trader into the mix, or if you just want to like, look at how I trade, I do my best to give you like my best quality setups as long as like with all my thought process and things like that. So go ahead and join if you haven't already. VIP Discord. you'll definitely go ahead and love it. You have Marco in there as well. You have Ivan, you have Chris, you have Nick in there. So you have lots of traders there to kind of pick from and just kind of look at. So you'll have a pretty solid rotation, I would say. But thank you, Marco, for your time, man. Have a blessed rest of your day. We'll see how the volatility picks up here. You have the metals bleeding and stuff like that. We'll see if there's any follow through to that. But we'll see you tomorrow, man.
Yeah, and I would definitely urge everyone to join and check out Alan's trades, because I've been following you for a couple of months, and you had some really big trades in terms of the reward to risk. So it's definitely worth joining. Thank you, Alan. I'm looking forward to seeing you tomorrow, and let's see what happens. I'm hoping we switch to risk on, but if we don't, some stop losses are about to get hit.
For sure, man. I actually have one that I'm watching here, euro dollar. If it does, I have my stop below the 61.8, so it's still pretty far out there. But
Okay.
if the entire kind of narrative starts to shift there, then likely I get stopped out. But we'll see. We'll see, man. Thank you again for your time, man. Enjoy the pizza, right? And I'm just joking.
Will do.
We'll see you, man. Take it easy.
You too. See you. Goodbye. Yeah, I saw a comment that another Adidas tracksuit has come in the mail, which is pretty funny. I have like 3 or 4 of those Adidas tracksuits, both the upper and the lower part. So I really like those. Ballout says, Mark, why did you get a new tire? I thought your method of transportation was teleporting. No, it was a tracksuit. It was a tracksuit. The tire thing was yesterday. Okay. Enough jokes. Let's go through the list. So let's go through the daily chart. 3 positions: Aussie dollar, Aussie NZD, and gold. A buy on gold. This one I was pretty happy about. My confidence level was a 9.5 out of 10. So really, really happy with it. Not so much anymore, but I still think the probabilities are there or were there if the stop loss is going to get hit. I thought the Kevin Warsh speech on Friday was, yes, hawkish, but a great thing to fade. Because Warsh, big talker, but when it comes to action, so far, he hasn't done much. So the Fed, I don't think they want to hike. We're going to get the NFP, we're going to get the PPI, we're going to get the CPI. I'm looking at poly market. I'm looking at the prediction for the numbers. It seems to be that the inflation is still going to print around 3.4% or lower. NFP around 50K, which is okay. But the main thing is inflation. Inflation still seems to be trickling lower. So I think the Fed is not going to want to risk. Risk. They don't want to hike. Okay, they love to cut. They hate hiking rates. If inflation is starting to behave, I don't think they're going to hike. Plus, the current rate is already restrictive, right? Current rate 3.5%, I think it is. It's already considered to be in restrictive territory. That's how I'm seeing the situation. I may be wrong, and I may get stopped out of my positions, but I think the reward to risk is there, the win rate is there, the probabilities are there, so the edge is in doing that approach. I was considering getting an USD CAD, no longer looking to do that. I don't want to go super crazy with the dollar shorts, so what I have put on is about it for now. I'm waiting for that NFP on Friday, and I'm trying to see if I can capture some alpha outside of the dollar. If I can do something that's not really connected with the dollar, like, for example, the Aussie NZD position that I already have, that is going to be my focus for the next few days. So again, the dollar, I don't want to mess with it too much. I want to leave it be, leave the positions, see what happens. But Aussie NZD, I really like as something that is not purely connected with the USD. Gucci tracksuit on the way. I cried when I seen that comment, macro. When I saw that comment roll through, I tried not to laugh on camera. You guys are a piece of work. I'll say very fun to stream. Reviews on the it's pretty fun. It's pretty fun. So keep up the comments because they just make the streams that much more entertaining. Views on the yen. The yen is tricky. I don't have a clear big view on the yen. I had one which was bullish yen, because the government in Japan definitely wants a stronger yen. They're doing an intervention. They're doing the GPIF, the pension funds, where the pension funds are selling foreign, buying domestic assets. You have Besant on the side of Japan wanting to help them, wanting to push the yen up. Now, the problem with that is the reputation of Besant is really low. Okay, the expectation that he's actually going to be able to do something is pretty low as well. His credibility, as they say, is low. So if Besant says something, it's usually faded. Just look at the long end. What did he say lately? Okay, now it's actually negative, but we have retraced the full move. So this is when Besant did the thing that he did, and we are now pretty much near those levels. So fade Besant is the name of the game. The only thing that could save the yen, the only thing that could actually save the yen is if you get the Bank of Japan to hike the rates back to back. So I'm talking about not one rate hike, I'm talking about 3, 4, 5 rate hikes all in a row. That tells you, or that will tell you, that the BOJ is serious, that they're not playing around, and the yen will go up on that. I think that is the only thing that can save the yen. We have the upcoming meeting, I think, in September for the BOJ, so we'll see. We'll see what happens. Personally, I'm trying to stay away from it. I don't wanna really mess with it. What could happen, like a really high probability scenario, would be UJ keeps grinding up, takes out the high, then you get the BOJ saying this can't continue. We need to do something, back-to-back hikes, and a big trend lower. And the yen ceases to be the funding currency. The yen ceases to be the currency that everyone sells to buy a high yield currency. Sluggy, you're live. I started long gold, mean reverting. Thoughts on the yen, Bashi trying to keep my head in this market. Not easy at the moment. The Besant. You also have Drunk Miller, Besant and Drunk Miller, which is a comment that I saw, I think, yesterday. So it's Drunken Miller, I think, but we're calling him Drunk Miller. I still like gold, but with BTC short covers. Bashi, I will say I don't like the all market after April. Scott Peasant and Drunk Miller. I wish Trump had a nickname for Besant. I kind of know what it would be, if I'm being honest. I'm not gonna say it here because some people may take it the wrong way, but if we ever get together in person, I'm gonna be much more open, let's say. So let's continue. I still have 3 more minutes. I need to mention the sponsor. The sponsor of today's video or today's stream is going to be Ola Prime. So if you're looking to get funded, you can get 20% off with the code A1 Live. So 20% off A1 Live. Ola Prime. Okay. So Ola Prime, no consistency rule, which is a big plus in my opinion. Check out their Trustpilot. If we go to Ola Prime Trustpilot, let's take a look. 4.5 out of 5, 3.5K reviews. Read through them. 5-star to 1-star ratio is pretty good, I would say, especially for this niche. I think this is a pretty good company. We have some traders in the Discord who have gotten steady payouts from Ola Prime. I think Max is even in some sort of an inner circle. So he's pretty happy with it. I'm pretty happy with it, or I'm pretty happy that he's happy. And yeah, if you want to take a look, if you want to get a good price, 20% off A1 Live Ola Prime. News in 17 minutes. Nope, not covering them. So my segment ends in, I think, 1 minute. But the news is not going to be market moving. Like if it was something big, we would cover it. It's just the ISM manufacturing. Like from my experience, I've never seen this thing move the markets much. If you get a total miss or a massive beat, then yes, it will be market moving, but it is very, very rare that this moves the market. I'm definitely looking at the Aussie GDP. I'm looking at the RBNZ cash rate because I bought Aussie NZD, so it'll be very important for me. But that's about it. So the three most important events are, for me at least, Aussie GDP, RBNZ, and of course the Fed. So not the Fed, the NFP. NFP, absolutely the most important event of the week. 55K is the forecast. Actual number, probably going to be about around 50K. That's how I'm seeing the situation. If it comes out negative, that's going to be very, very good for my positions. So anyway, I think I'm the last guest for today. Let me take a look at the schedule. I don't think Tiger is coming on. Nope, no Tiger today. I want to thank you guys for watching. I want to mention, if you want to join the A1 Discord, there's a link in the description. If you want to work with us, get our trade ideas, you can do so. Every information is on the website and in the description. I wish you a great rest of the day. I'll see you tomorrow, and that's it. Goodbye.
Have you ever wondered how you could find more trades like this gold runner, or the S&P 500 breaking out to all-time highs, or this sell-off in dollar Swiss franc, which was a clean short opportunity? Well, all of these charts shared one major thing in common. They all had powerful macro fundamental catalysts driving price decisively in one direction, presenting a really strong trading opportunity. Hi, my name is Nick. I'm a 10-year trading veteran and the founder of A1 Trading, where we build market scanning software that help traders to track macro fundamentals, crowd sentiment, and the commitment of traders' data to best understand where institutions are moving their money. Our tools automate everything from studying jobs market data, inflation statistics, and economic growth metrics, bringing it all together into a scorecard or rubric that helps to spot better potential trading opportunities through our insights offered by the tools. So if you're looking to access our tools, stream viewers get extra discounts, and we're currently offering payment plans as an option for those who would like to split up the cost of our tools into a couple monthly payments. Alternatively, we also offer a free Edgefinder tutorial course, as well as fundamental macro course that can help you to learn the concepts behind the tools. Scan this QR code that you see on the screen right now to be connected with a real person from our support team. We have helped thousands of traders level up their trading through insights, dashboards, and automation. And we are passionate about this subject because having the right tools that hedge funds and proprietary firms keep locked in key is a powerful game changer for the average everyday retail trader. To explore our products, payment plans, and just to find out more and speak to a real person about this, scan the QR code that you see on your screen right now. Alternatively, the link can be found in the live stream chat or in the description of the live stream. On our website, you can find a collection of both free and premium trading tools that our team has put together to help traders take their trading to the next level. Well, you might be wondering, how can your tools help me? Well, whether you're a swing trader or a day trader, our tools are meant to help traders of all different levels of skill, time frame, and traders that trade Forex, commodities, indices, stocks, etc. At the core of it is automation, simplicity, and bringing it all into a one-stop shop for you to scan markets more efficiently and build a curated watch list of potential trade ideas. So regardless of what you trade, we hope that our website helps you in some way. And if you have any questions, feel free to contact us using the contact button in the top right or the live chat feature available on our website. We also offer free courses on fundamental and technical analysis on our website, as well as a range of free tools like, for example, our risk calculators that can help traders to level up their trading without paying a dime. Our goal is that our tools and site help you in some small way, and we wish you the very best in your trading journey. Thanks for listening.